Okay, hi Cheryl, are you well?
Yes, how are you?
Yes, good thanks. Okay, everything's working fine. The
Good.
screen is up.
Yeah.
Okay, great. So obviously I sent through the video last week, so at least you have those resources if you need to obviously go back and look at specific topics that we might have covered in the past. Did you have any questions from last week in terms of those basics that we looked at from 1502?
No,
Okay, great.
I
So if you're
didn't. Yeah.
comfortable, then we can just wrap up the last few slides here, looking at a few other adjustments relating to 1601 disclosure, and then we can actually start with the textbook content. Okay.
Okay.
We had a note here about adjustments. You do need to remember all of them because they do tend to come up in different questions where you've been given specific adjustments regarding the disclosure of maybe a close corporation, a sole proprietor, maybe even a partnership or with companies. Okay, these adjustments can come up in any situation. As long as you're dealing with a financial year end, you need to remember that these year end adjustments provide for those 12 months during the financial year. It's generating a more accurate set of financial statements because we're actually representing things as they are. If I've bought stationery during the year and I haven't used all of it, then I need to show the portion that's an asset because it's something that I'm going to use the next year. So therefore, you create stationery on hand. So those are the different adjustments. There are a few others that we need to consider. This is the first one. Do you remember your allowances from last year? Do you know what an allowance is?
It's basically, okay, my understanding would be it's basically money or a certain amount of money that companies keep aside in case there's credit losses or.
Okay, not quite. So they don't actually keep money aside for it. I think you're thinking about an allowance. For example, like a student might have a allowance. Okay, a student allowance could
Oh,
be given by their sponsor or their parent. So it's not that kind of allowance. This allowance is often called a provision. So I know from last week you said you haven't studied accounting before, which is fine. You don't need to have studied it before. This course that you're doing now is adequate in terms of the knowledge that you have from your previous one, which is 1501, and then to build on it to then complete other courses later on. So sometimes other textbooks talk about this as being a provision. So the word allowance just means you are providing for or you're creating a note in your actual financials that relate to something that hasn't happened yet. So creating an allowance, it's almost like an expectation. When you look at debtors, do you know what type of account debtors is?
an asset.
Very good. Okay, what type of assets?
Current?
Very good. Okay, so when you look at the disclosure, remember this whole module, 1601 is all about disclosure. Short term assets or current assets are going to be disclosed in the statement of financial position. So when you show debtors on your statement of financial position, are you showing the debtors that are going to pay, or are you going to show the debtors that aren't going to pay, or do all the debtors just get grouped as one? How do you
All the
show
data is
debtors?
grouped as one.
Correct. Okay,
Yeah.
remember when you disclose debtors on the statement of financial position, you don't have the debtors that are good showed separately from the debtors that are bad. Does that make sense?
Yes.
Okay, but based on past experience. So when you look at accounting theory, when you look at the conceptual framework, accountants have to record transactions accurately, and those transactions are based on source documents. So do we have a source document for a debtor? Yes, we do. That source document would be the invoice that represents the credit sale. But now, if you've sold goods to a debtor on credit, you are going to have debtors as a current asset on your books. But do the debtors always pay? Not always. So
Mm.
when you have an allowance, sometimes companies provide a provision or an allowance based on what they know. So let's assume that I have 100. Okay, it could be 100,000, 100 rand, 100 million. It doesn't matter. I'm just using 100. It could even be 100%. Okay, but that's the amount that I have here in terms of debtors. But let's assume we've been operating for a few years. Let's say we've got data from the last 5 years. And when we look at that data, we can see that based on what we know, in the past 5 years, 5% of our debtors, okay, do not pay. In other words, over the last 5 years, we've always had to write off 5% of our debtors. They've never always been the same debtors. So in other words, when companies sell on credit, they don't sell to the same people every year. Okay, every year they sell to different individuals, different customers. So if you're a business and you're selling to different debtors on credit, there will be a trend that you'll pick up on. So when you sell to customers on credit, a portion of them aren't going to pay you, either because maybe those individuals were retrenched, maybe they can't afford it, maybe they're bankrupt or they're insolvent and they can't pay you. And based on past experience, 5% of those debtors don't pay. So now going forward, if I'm showing 100 or 100% or 100 million or 100,000, doesn't matter. If I'm showing debtors, whatever it is, on my statement of financial position at 100, am I telling my user the truth? Well, not actually, because in actual fact, I need to show them minus 5%. Why do I show them minus 5%? Because I need to tell them what I know based on my reliable estimates. Okay, so accountants show a provision to provide for eventual bad debt based on past experience. Right? If you know based on past experience that every year you're writing around 5% of your debtors, well then it's actually better to show them the 95 rather than the 100. Because that's more reliable, it's more accurate, and it's being more truthful to the users, right? The person who's going to be looking at those financials. Because it's very easy to show more debtors. What do? Just give people more goods. Sell more goods to them on credit, right? So if I'm looking at the sales side, customers can choose to increase their sales by letting everyone buy on credit. But that's not going to help the business, because what happens if none of them are going to pay us? And that's a problem. Are you going to have more sales? Yes, because you debit the debtors rather, and credit the sales. Remember that from last week?
Yes.
Okay, so if I'm debiting debtors and crediting sales, it's so easy to show more income and more assets. Right, so if the company is a dodgy company, a Steinoff, for example, Steinoff could just create an asset by recording debtors for credit sales and show more income by selling to people that can't even pay. Right, so credit sales is good, but it's problematic in terms of information for the user because the business likes it. Right, which business wouldn't want to show more debits for assets and more credits for income? Okay, it's almost a no-brainer for a company to choose to show more income and to show more assets. But the problem with that is you have to reliably estimate the actual debtors that are going to be shown or disclosed on the financial statements. Right, telling the user the truth is important, and that's why you create this allowance. Right, so what type of account is the allowance? It's a negative asset. Why is it a negative asset? It's because it takes away from your debtors. So when you disclose debtors in your statement of financial position, under current assets, you'll have debtors minus the allowance for doubtful debts. Right, that's how you show it, or allowance for credit losses. Right, doubtful debts, credit losses, same thing. Okay, different textbooks refer to it slightly differently. Right, there's a lot of different ways of referring to this. Sometimes textbooks will refer to this as a provision for doubtful debt, or a provision for bad debts. Right, so as long as you can understand how this affects disclosure, you'll be okay. Because in some questions, you will see an allowance being given because the allowance is going to affect the debtors, okay, the disclosure of the debtors. Because you need to work this out first, and then you show the net amount after you've subtracted this negative asset. All right, that's why there's a note here in brackets, disclosure. Okay, hopefully you printed these notes, or if you're using a digital version, remember it's electronic, so you could probably open this up on your phone or your tablet or something else, and then you can still watch the class like this, and then you can still write on the actual note if you need to. There are writing tools in in the PDF. I don't know if you're aware of that, but you can actually write on your notes and you can save it. So if you haven't printed it, you
So,
can write these notes in
so
because that wouldn't be in your notes.
yeah, so the way I do it is I watched it over again
Okay, awesome.
and
Wow.
I write it out from scratch
Wow,
for
that's
the way
amazing.
I understand it. That's just my method.
Okay, that's amazing. Yeah, different students have different
So,
methods. So if you
yeah,
found a method that suits you and it works for you, then keep doing what you're doing. That's great.
because I prefer writing, I feel like it helps me compared
Yes.
to digital. So that's
Yes.
just, yeah.
Okay, nice. Great. Yeah, it's always nice to know what your technique is because I know some students do it differently. Some students don't even write notes, they just look at the textbook, but they highlight and circle and they actually write notes in the textbook for different sections. Yeah, so this I'll look at, but not now, obviously in practical questions.
Yeah.
Okay,
Okay.
then you debit the credit losses. Why? Because you're creating an expense. Okay, you're recording the expected bad debt. You're telling the user, this is what we expect. We're showing debtors, but we're showing the correct amount of debtors. We're providing for debtors that may not pay based on past experience. Right, and you don't always have to increase or create this account. Sometimes you've got to debit and credit the allowance because you're creating it. Sometimes you need to decrease it because you're lowering it. Because remember, the allowance will stay on the accounting records year on year. Right, so maybe this year, because businesses are struggling to get payments from debtors, you might have 10% being provided for as an allowance. Last year, you maybe only had 5%. Right, so every year you'll have an allowance for credit losses, and every year you'll either adjust it up or down depending on the situation that you have at hand. All right, does it make sense?
Yeah.
Good. Okay, so that's why I've shown a debit here and a credit. The reason why you have a debit here, because this is a negative asset. So it's the opposite, it's the inverse. Remember, an asset looks like this, plus and minus. Okay, so a
Yes.
negative asset would be on this side. Agree? So if you're going to
Yes.
reduce a negative asset, you're actually going to debit it, not credit it, because the negative will decrease by adding to it. Okay, just some basic maths. Right, if you had to
Yeah.
increase the allowance, then you would do the opposite. Because this account is a negative asset, to increase the negative amount, you have to minus more. Okay, so you'll process more credits to increase it. So credit to increase, debit to decrease for an allowance. Right, but that you don't have to study. These notes are here for two reasons, right? It's for students that struggle to apply, okay, the rules because they've just studied accounting. Then they can just study that and remember that, and that's fine. Okay, you don't even need that if you just remember what it is. This is what you need. I just need to remember that an allowance is a negative asset. Then I can do whatever I want to it. I can increase it if I want to. I can decrease it if I want to. I just treat it as a negative asset, which will have a credit balance. Happy with that?
Yes.
Perfect. All right, depreciation. This depreciation is revision from before. We even looked at it at the actual, we looked at it in the assignment when they actually asked you some questions regarding the depreciation for a particular year. The biggest tip that I can give you here for this section is a timeline. Okay, the start and the end. Right? It doesn't matter how easy or difficult the question is, you must always draw a timeline because then you can see everything. Right, so on my workings that I had covered with you previously, you saw those diagrams. Those diagrams are there because that's the approach. That's the best approach because then I can see everything and I can work out pro rata depreciation if I need to, or I can look at disclosure if I need to, because sometimes you might be here or you might be there, and then it'll affect the workings in between. Okay, maybe you have an addition or you have a disposal. Right, then I need to look at that. Right, so biggest tip for this section, draw timelines. Always. Right, so straight line, you probably know from before. Straight lines don't change in terms of their shape. Okay, they stay straight. So the cost price never changes. That stays the same because the cost is based on the historical cost or the historical amount that is present when you have bought a particular asset. Right, remember, you need to have intention. Your intention is to use the asset, not to sell it. Right, because if I use the asset, I'm going to have depreciation. If I'm going to sell the asset, then I'm going to have inventory. Okay, so just be aware that when you look at property, plant, and equipment, when you're specifically looking at depreciation, you're looking at the use of a particular asset. That's the most important thing, right? So that's all depreciation is. Depreciation is just the use of an asset recorded over time, and it's seen as an expense. When you do the calculation, you're either going to use this method, straight line, which is based on cost, or you'll use diminishing balance, which is based on carrying value, right? And it's straightforward because think about it. Carrying value, what happens to the carrying value over time? It changes. Do you still remember the formula for carrying value?
It would be cost minus accumulated depreciation.
Nice. Good job. Well done. All right. Sometimes, depending on the level of difficulty, there could possibly a scrap value. Sometimes they talk about a residual value. Okay, a residual value can be discussed in certain calculations relating to depreciation. It's just an additional consideration. A residual value just means what is the asset valued at the end of its useful life. And if it's going to have a residual value, you never depreciate this value. The residual value is what you leave out of the depreciation calculation. Right? If we see that come up in questions, then I'll address it and I'll go through it in detail. Right, but it's something to consider. When looking at the carrying value, the same thing can apply, but the nice thing about carrying value is it diminishes, but it never ever reaches zero. Right, hence the name diminishing balance method. Right, it's a method whereby you're constantly processing a smaller amount of depreciation, and it'll never end. It'll continue and continue and continue. It'll get smaller and smaller, but ultimately it won't reach zero. Okay, it's a carrying value based calculation. Right, and that's the important bit. What's in color is important. Cost for straight line, carrying value for diminishing balance. Right, asset disposal, something else that I've seen in past exam type questions and assignments. Sometimes you might be asked to process the sale, the writing off of an asset, or even the trade-in. Right, so how do you approach it? You use the realization account. This is a working account. Working accounts don't have opening and closing balances. Another working account that you might be familiar with is profit and loss. Profit and loss is a working account, or even trading account. That's another one. Okay, trading account is used to work out gross profit because you'll have sales and cost of sales. Right, this is part of closing transfers that you would have covered in 1502. Profit and loss, that helps you to work out net profits. And that amount is obviously referenced to capital. Right, so profit and loss and trading account both are working accounts because you close them off. You basically put totals and they never ever have a balance brought down or a balance carried down. Same with the realization. You'll never ever ever have a balance brought down or a balance carried down. It gets closed off when you process the asset disposal or the asset realization. Okay, I think this textbook uses the word realization. Others use the word disposal. It's the same thing. Okay, you're basically getting rid of an asset that has been on the books of the business as a non-current tangible asset under PPE, property, plant, and equipment. This only applies to property, plant, and equipment, asset disposal. It doesn't apply to inventory. It doesn't apply to debtors or anything like that. Okay, it's a very specific consideration. Assets that are bought and that are used can also be sold or written off or traded in or disposed of at the end of its useful life. Right, so how do you do it? Well, there are some steps here that you can use. These are steps that the textbook would guide you through in terms of application. Right, there's no real, let's say, how can I put it? One shoe doesn't fit all, basically. So if you learn this process, it's fine. But sometimes the process can change slightly because of the way the question is phrased or the way that they've tested it. Sometimes they give you parts of this process that have been completed, and then you've got to complete the rest. Right, so maybe they've already accounted for the accumulated depreciation, or maybe you still have to account for it. And that obviously changes the way you approach it slightly. The biggest tip I can give you here is just remember that when looking at a realization, okay, you're comparing the cost to the accumulated depreciation. That's all, right? And you use this realization account to do the working, right? And then in the realization account, You'll obviously have proceeds from the sale of an asset, and you might have a profit or loss on the sale, depending on what you've got. And again, you can apply basic rules. Okay, debit or credit. If it's a loss, it'll have a debit balance. Why? Because it's an expense. If it's a profit, then you'll have a credit balance. Why? Because it's an income. Right, so basics always apply. Right, the profit on sale would be an income that you'd record. A loss on sale would be an expense that you would have to record. So if you know your basics, you'll know if it's a debit or a credit, and then you'll do the opposite in the realization account if they ask for T accounts. Right, T accounts aren't that popular in 1601. Okay, this module. Only because they test the disclosure such a lot. They give you statements, income statement, balance sheet, okay, or the new names, okay, statement of comprehensive income, statement of financial position, or statement of changes in equity. The T accounts you're going to see a lot when we do our cash flow. Okay, I like T accounts because you don't have to worry about rules. You don't have to worry about format, okay, because you can use the format to do cash flow, but it's easier if you just apply your basics because everyone knows how a T account works. You've got a debit side, you've got a credit side, and you need to have both. And if you have both, you can address that in a particular question, right? It's the same as incomplete records. That would have been one of the last chapters you would have done in 1502. And in that section, you would have used T accounts to work out certain unknown values, especially when you're looking for something like cost of sales or maybe inventory or something like bank or debtors, okay, that you can work out from a particular T account. Right. Are you okay with the asset realization? How's your asset disposal? Profit and loss?
I think it's okay. My only thing would be, why would we debit cost?
Why would you debit the cost? Because you're going to be writing off the assets. So let me show you. Okay, so when you have a realization account, what did we say this account is going to do? It's going to help us work out a profit or loss. So when you have a vehicle, all right, what balance does a vehicle have?
A debit.
Good. So let's assume I have a vehicle and the vehicle is 30,000 Rand, okay, in terms of its cost, right? And we're going to write it off. Okay, it's an old vehicle, we're going to get rid of it, okay, or a machine, whatever it is. Okay. How do I get rid of this cost? I have to credit this account.
Okay.
Do you see it? So to close off this debit, you credit this account, and then you'll write realization here. Okay, so so if you're looking at the journal entry, the journal entry would have been credit, vehicles, okay, asset decrease, and then the debit would have been here.
Okay.
Vehicles, and then you'd show the 30. Okay.
Okay.
All right, so then you'll have a debit for realization or asset realization. Okay, this is a working account. It's not an accounting element. All right, so you have to have a debit, you have to have a credit. Right, when you do partnerships, I'm going to refer to a working account again. So use this one as a reference for later on. Okay, there are other working accounts. I spoke about two earlier. Trading accounts and profit and loss are working accounts. Right, realization is a working account. The one that you'll see later is a valuation account. When you do partnerships, you have to value the partnership. That valuation account is also a working account. And then you'll have the same thing like I've got here. You'll have a debit and a credit, but the one will be for a working account and the other will be for a normal account. Right, so when you have a vehicle, the cost is always going to be on this side because you're looking at the realization, you're removing the vehicle from your records. So you're crediting the vehicle account and then it gets transferred to the realization account. So this credit is referenced with that debit. Right, in the working account, the normal rules still apply because in the working account, you're looking at vehicles as an asset. So it must be on the debit side, but you've just taken it out of the vehicles account because you might have had other vehicles. You might have had another vehicle maybe for 200, Okay, so I'm selling the one for 30 and I'm keeping the one for 200. Does that make sense?
Yes.
Okay, so the realization is only going to be for the 30 because I'm going to take that out and I'm going to take that out basically.
Okay.
Okay. All right, here's that note about those other assets. Okay, so intangibles or financial instruments, cash investments, investments in shares, something that does come up from time to time. It's not that popular, but um, I know you haven't bought that textbook, the first one, volume one. Volume two is obviously this module, but it doesn't cover volume one. But in volume one, had you purchased it, there would have been a chapter on it, right? And that's why this is part of my set of notes for 15 for FAC 1501 or 2 actually. It's because it actually used to be part of the content, the material. There even used to be a study guide chapter on it, but a small one. It was like I think it was about 5 pages. But I see in your study guide, it's not even mentioned. It might have been in the previous module. I don't know if you have your 1502 material still, probably, but it might have been
Yeah.
a separate chapter, but it's very, very, very short. Right, but I'm going to elaborate on it here because had I covered 1502 with you, I would have covered it there, but it wouldn't have affected your 1502 much, okay, because they don't really examine it, but they do examine it in this module. But this module doesn't cover it. That's the only problem. Okay, this module covers it in that other module. They might have improved the study guide a bit, and maybe we'll see it in the study guide. But until we've seen it in the study guide, this is something that would have only have been covered in 1502. Okay, but after we've looked at it, you'll get it. It's quite simple. It's not very difficult, as long as you know what an asset is, as long as you know how an asset operates. Right. So, do you know what the effect is going to be on all of these different types of accounts? So, when I talk about the effects, we're looking at the rule. So, in other words, if I had to increase it or if I had to decrease it, what am I going to do to these accounts, irrespective of what I've got?
You debit it.
Debit
I'm
when
going
I
to
do what?
increase it.
Debit when I do
Sorry?
what? Increase or decrease it? Which one?
Increase.
Yes, good. Okay, so don't overcomplicate it. Keep it simple. Right. Accounting changes. So if you do more accounting, if you do a second year level accounting or a third year level accounting or even honors and stuff like that, okay, you just get introduced to other types of assets, liabilities, income, expenses, capital, and drawings. That's it. Right. In this module, the biggest element that's going to be elaborated on is your capital account. Okay, last week you even asked me that question. You asked me about what capital do we have for other types of businesses. Then I spoke about share capital, members' contribution, capital A, capital B. Remember that?
Yes.
Yeah, so in this module, see, you're taking one of those elements and you're taking it to another level, right? You're taking something simple, which is capital, but now you're adding more to it. You're considering other forms of ownership, right? When we look at an asset is an asset is an asset. No one can change the definition of an asset, but we can have lots and lots of different types of assets. So when you start at 1502, one of the earlier assets that you would have covered would have been inventory. Okay, that would have been a separate chapter. And then later on, you would have covered debtors. Okay, and then later on, you would have covered cash and cash equivalents or bank. Okay, as part of the bank recon. Then you might have looked at petty cash. Right, all of them are assets. And then ultimately PPE, right? Okay, that's one of the later chapters. Right, notice all of these are assets, but they're assets in different contexts. Either assets that I'm selling, assets that I'm using, right, or assets that I'm generating from credit sales, or physical cash. Right, but the point is it's an asset. Same as what we've got here. It doesn't matter what it is. Intangible, financial, cash, or investments, they're all considered assets. Then you just need to treat them like an asset. Debit plus, credit minus. That's it.
So what would you credit?
What would you credit? Well, it depends. Let's assume you
Okay,
were
so,
investing. Right, let's say you were buying
okay.
shares. So if I was buying shares as an investment, as a company, remember companies can invest. So companies would have an
Yes.
investment in company A. Okay, and then they'll credit the
Okay.
bank because they need money
Bank.
to invest.
Okay.
All right, so do you see? It's just basics. Debits, credits, okay, two accounts, two elements, two effects. This would be an asset that would increase. This would be an asset that would decrease. And there's the
Yes.
working.
And intangible assets, so would you
Intangible assets
also,
would be something like a website or a
yeah.
copyright, a trademark, a patent. Okay, does that make
So would
sense?
you credit bank as well?
Well, you have to buy those things. If you want to buy a trademark, let's say you want to buy copyright, or let's say you want to buy intellectual capital, right? Let's say you want to buy a patent. Okay, patents have to be registered. Okay, so if you're going to
Yes.
buy a patent, you can actually, or register a patent, it's going to require funds. All right, so again, debit bank,
Okay.
debit the patents. Right, or financial
Okay.
instruments, that could be an investment, right? A fixed deposit. Debit the bank, debit the fixed deposit, credit the bank. If it's
Okay.
cash, even with cash, how did you create petty cash? Debit petty cash, credit the bank. Okay, the money has to come from somewhere. The notes and coins have to come from somewhere. The notes and coins would have come from the bank accounts, and then I would have created it. Okay, well, inverted commas,
Okay.
create. Right, debit petty cash, credit bank. That's how we create petty cash.
Okay.
All right, so it's all basics. It's all simple rules. Okay, hopefully as we do more together, you'll kind of get a feel of how I approach accounting because it's simple. It can be simple. It can be complex as well, but you need to keep it simple. When students start trying to make it complicated, then it creates a challenge. It creates a problem. And also, I always take it from a point of view of a student that isn't going to specialize in accounting. They're obviously going to look at other subjects. So maybe it's finance, maybe it's investments, maybe it's um, business management or whatever it is. But the accounting is important just for a foundation for students to then apply and use in other subjects later on. All right, so there's a note. You asked about some of them. Tangible, property, plant, and equipment. Intangible, there's a whole bunch of different assets. This one is important because you'll see goodwill calculations later on when you look at partnerships. Okay, is goodwill an asset?
What is goodwill? I know it's an asset, but what is it?
Okay, goodwill is the brand. Goodwill is the reputation. Goodwill is something that is intangible. You can't see it. It's not physical. Right, so think about a
Yes.
brand. Last week you told me about Adidas. You like Adidas.
Yeah.
Okay, so is Adidas a brand?
Yes.
Okay, why do you spend around 1,000 rand for something simple, like a t-shirt maybe, or a nice whatever? Why can you
Reputation,
charge
probably.
500 rand to 1,000 rand for a shirt? It's the brand. Isn't it the goodwill?
Yeah.
Wouldn't
Yeah.
you agree with that?
I would.
Okay, so if you're looking at more expensive items, premium brands, okay, they're premium. Premium means you're paying for brand, you're paying for reputation, you're paying for something that has been established. Apple, okay,
Yes.
Apple can charge around $1,000 for a new phone purely based on branding, okay, based on its reputation. Right, so goodwill is the other stuff that you can't actually see that gets generated over the life of a business. Right, businesses
But
that
how is
have
it
been operating.
calculated?
Sorry, say that again.
How is it calculated?
It's calculated based on the value of the assets and liabilities, and that you'll only see in partnerships. Okay, goodwill can only be calculated when you're looking at the assets and liabilities of a partnership when there's a change in ownership. Right, so if somebody's going to buy it, then you can say there's goodwill. So for example, right, I can also create a brand. Let's call it AF. Okay, if I create a brand AF, I can also charge 500 Rand for a shirt. Right, but is anyone going to buy it? Probably not. Why? Because it's not Adidas or not Nike or whatever, right? Okay, so this, okay, is only going to apply. Goodwill can only apply if there's a transaction, if there's a purchase. If someone's willing to pay 500 for that t-shirt or that shirt, right now I can say, well, now there's goodwill. because they're recognizing additional value in a made-up brand, right? And that can only be
Okay.
established, it's measured. So with goodwill, the measurement is a little bit tricky because they talk about the acquisition, okay, acquired goodwill. All right, so goodwill can only be evaluated, measured, considered when you have a willing buyer, when somebody is willing to buy a part of the business. All right, so if we're in a partnership, okay, let's say it's AS, okay, in partners, right, and now we're going to bring in another partner. We're going to bring in AS, let's just say we're going to bring in B, okay? If we're running a partnership, all right, our partnership will have assets and liabilities. Right, if B is going to come into our partnership, we're not going to let them in for free, okay? Because we've worked long and hard to establish a business that's worthwhile, that's valuable, right? So if we've created value, why should we let B come in without any compensation? Okay, they call it a consideration. So if B is going to enter into the business, we're going to give them a third of the business, but they must pay for it. Right, maybe they're going to pay us $1 million for a third. Right, so now how have we done in terms of our business? Well, as a partner, I will have a stake in the business, you will have a stake in the business. And the goodwill that's created is based on the value of the business. So if the new partner is going to pay $1 million for a third of the business, would you agree that our business is worth $3 million? Because it would be 3/3, 3/3. If one
Yes.
third is priced at $1 million, well, then the whole business should be priced at $3 million. Do you agree?
Yeah.
But now, what happens if we've only got liabilities of $1 million and we've got assets of, let's say 3? Okay, how much is the actual business worth? Well, in terms of owner's
2.
equity, what is A minus
Yeah.
L? Owner's equity. So owner's
Yes.
equity here would be 2 million. Do you agree?
Yes.
So now, what is actually happening? Well, in this scenario, B is paying 1 million for a third of the business. The business, in actual fact, would be valued at 3 million, but we only have equity of 2. So there's goodwill of 1 million because it's the brand. All right, someone's
Okay.
willing to give us more for something that's worth 2 million. Right, and
Okay.
that's why it only applies in a change of ownership. So you'll only see this in a change of ownership when we look at partnerships. Right, and it works exactly like how I've explained it. Right, sometimes, so for example, you're probably willing to pay more for Adidas because you like it. And you could probably get the same item or similar at a much lower price. But now you're giving the company goodwill. Okay, the goodwill is
Okay.
the premium that's attached to that item. Right, assuming you could get the exact same item from store A and then you could buy the same item at store B. Okay, the one store might have more goodwill than the other because they're charging a premium for the product. The product or the business is worth 2, but we're actually selling it at 3.
Okay.
Okay.
Okay, that makes sense.
Yeah, I'm glad it does. You're actually a little bit ahead. You're looking at change of ownership. I will discuss it when we get there, and then we'll look at it in more detail. Right, so goodwill is something that's important. That's why I highlighted it. You will see it. The others you won't. Right, you won't see brands or copyrights or patents or anything like that. Right, so financial instruments. They can be an asset or they can be a liability. Why? It's because the value can change and you can also have different types of instruments. So with equity, you've got ordinary shares, preference shares, convertible. For contractual agreements, okay, those are contracts. So for example, you have the rights, okay, to do something, right? Or you have the right to receive something, right? Those are contracts. Those are instruments. And then you've got debentures. Debentures is like a loan. I've said loan type shares because you split it. Okay, this you'll look at more in finance modules. So think about a big company like, let's use Eskom. Okay, Eskom needs resources, right? Okay, to build a power station, it costs billions of rands. Okay, maybe 2 billion to build a power station. Right, is Eskom going to take out a 2 billion rand loan with one provider? Probably not. Why?
No.
Well, no provider is going to want to give Eskom 2 billion because it's risky.
It's high risk.
Exactly. Right. So what do? They create debentures. So they make a 100 million rand loan, they make a 200 million rand loan, they make a 500 million rand loan, and they say, who wants a piece of the loan? All right. Maybe one bank gives them 100 million, another bank gives 200, another bank gives 500. Okay, and that makes up the 2 billion. So a debenture is like a share, but it's a share of a loan. Okay, it's basically just breaking up a loan into parts. That's all it is. Okay, so it's just different products. Okay, there's lots of different products. Banks make products all the time because they have products and services they need to offer, and when the markets change, they obviously offer different offerings or different products or services to attract customers. Okay, to serve a particular need, okay, or a want. Right. So when you look at the financial asset disclosure, it doesn't matter what asset you're looking at. It can be equity, it can be a contract, it can be a debenture. The point is you need to always look at this, the market value or the fair value, because these things will fluctuate. Right, the price of shares will change, the price of the bonds will change, right, the price of a particular asset will change. So when you look at disclosure, it's very strict. You have to disclose the information according to what it's worth. Right, because today you might have bought shares and the shares are at 100 Rand or $100. Let's just use Rands. Okay? And then next month it's at 200. All right? Or it drops to 50, whatever. Okay? The point is that your asset is no longer worth 100. So can you show your user 100? No, you shouldn't. You should show them what the actual shares are worth or what the actual asset is worth in terms of the financial instrument. Right? So if businesses hold assets, they have to mark the value of those assets according to fair value or market value. And that's why you've got this page here. All right, so how do we invest in assets? Well, the initial investment is going to require money. So if I'm going to invest in a fixed deposit, I'm going to debit the investment, I'm going to credit bank. Okay, do you know why? Can you give me the reasons? Use my approach.
Because you're increasing, okay, so investments and assets, so you're increasing it.
Yes.
So therefore debit, and then you're taking money to pay, so you're decreasing your asset, therefore credit bank.
Very good. See, that's the right approach. So keep it simple, break it down to basics, because even if you've never seen a fixed deposit in your life and you haven't studied it from a list of accounts, because remember, if you've studied what are assets, then you need to remember it on a list, right? And then if it's not on your list, now you get stuck, because I can change this word fixed deposit and I can put investment in company A. Right, and investment in company A would be similar to a fixed deposit. It would be similar to any other investment. So as long as I know what it is ultimately, it must ultimately be one of the 6 accounts. An asset, liability, income, expense, capital, drawings, that's it. Right, it can only ever be one of those 6. Right, so if you know which of the 6 you're dealing with, then it's easy to increase it or decrease it. So what happens if I receive a return from my investment? Well, capitalizing the returns. To capitalize means to add to the value of the asset. Okay, that's what capitalizing means. It's a little bit different to capital, because capital, you've seen it before, but capital is money given by the owner to the business. The word capitalize means to add, okay, to the underlying amount. Right, so let's assume I invested $1 million. Okay, so $1 million came out of the bank and $1 million went into the fixed deposits. Okay, what happens now when the bank is going to give me interest on the $1 million? Right, let's say they give you 10%, okay, and you get 100,000. All right, so if I'm going to get 100,000 from that investment, what's going to happen to my investment? Well, if I'm going to keep the investment and I don't want the 100,000, I want the investment to grow, then you're going to capitalize the interest. So you debit the investment and you credit the interest income. Why? Well, you're earning income. The income will be credited and the asset will increase. Right, so now you're going to disclose on your statement of financial position under assets, you're going to have an investment that's going to be brackets 1M okay, plus 1 or 0.1. All right, so it's going to be 1.1. Does it make sense?
Yes.
Okay. All right, if you choose to get paid out, right, so we're not going to want to grow the investment. We want the investment, the proceeds from that investment to pay out. If you're going to pay it out, then you're obviously going to debit the bank and credit the income instead of debiting the investment. Right, so the first option is capitalizing, meaning adding to the underlying investment or getting the actual cash, receiving the money, physical money going to the bank account. Asset increase, income increase. Notice both are identical. The only thing different here is what? The account
Bank
being
and
affected.
investment.
That's all.
Yeah.
Okay, and that's what accounting is all about. It's just about record keeping. Right? I have to record things appropriately. The net effect is the same, but the cash flow is very different. So if I was looking at cash flow, just to bring that into the discussion, is this a cash flow?
No.
Definitely not. No money came out of that investment. Is this a cash flow?
Yes.
Yes. Right, and those are things we'll look at later when we look at cash flow. Right, it's very simple because you look out for this. Search for bank,
Yeah.
find bank. Right, there's no bank here, there's no cash flow. Right, so if I'm investing, there's cash flow. What cash flow do I have here?
An outflow.
Good. Right, so investing is actually bad from a cash flow point of view. Right, because it
Okay.
requires an outflow of cash. Right, it could create future benefit, but that's the accounting side of things. Remember last week we spoke about accruals versus cash.
Yes.
There's a difference. Right, an accrual basis or principle looks at income that's earned and expenses that are incurred. Cash looks at money coming in, money going out, that's it. All right, so when you look at cash flow, the reason why students get confused is because they're thinking like an accountant when they should be thinking like a financial manager. Okay, finance is looking at inflows and outflows because that's more important. Right, accruals, accounting. Right, accountants want to know whether you've made a profit or a loss. Making a profit might not be good if you don't have the cash. Okay, because anyone can sell on credit, but then I get nothing. I don't get any cash. Right, so the business can actually
Yeah.
fail if you sell too much on credit and no one pays you. Happy with all of that?
Okay. Yes.
Perfect. All right, then I've just shown the other half of it. So what happens if you have shares? Okay, something else. These are things that you'll see in the actual practical examples. Okay, so when you're given a disclosure question, you might see some of these crop up. Okay, so debit the investment, same as before. Doesn't matter what the investment is. Okay, it can be shares, it can be a fixed deposit. It's still an asset. You need money to invest. So you're going to have to credit the bank and debit the asset, whatever it is. Here it just happens to be equity. Right, what happens if there's transaction costs? Would that be separate or would that be part of the transaction? What do you think?
Would it not be an expense though?
Yes, very good. Okay, so it is
Oh, okay.
separate and it is an expense. So what would you do?
So I would debit expense and credit bank.
Yes, credit bank, but be more specific. Expense is very broad.
Oh, okay. Transaction cost maybe.
Yes, there we go. Good. Okay, remember you get lots of different types of expenses. So when you account for those transactions, you record those accounts in the accounting record. So this could be bank charges or transaction charges or investment fees, whatever it is. Okay, so debit the transaction costs, expense, increase. Can you adjust the investment? Yes. Remember we spoke about fair value, market value? All right, so let's assume here at the beginning, all right, we bought 100 shares and each share was worth 100 Rand. How much would I've taken out of the bank account? 100 times 100, which is 10,000.
Yes.
Right, so 10,000 Rand would have been invested. Agree? Okay.
Yes.
If I'm investing in company X has to be accounted for accurately. That word accurately is important because according to the conceptual framework, accountants need to be accurate. They need to faithfully and truthfully and honestly represent the information as it is. Right, so assuming this happened, okay, let's say in March, all right, and now we're sitting in August. Right, and those shares are now worth 130 Rand a share. Okay, what are we going to do? Well, if I'm looking at the investment, how much is the investment going to be worth now? It's going to be worth 13,000. Do you agree?
Yes.
Okay, 100 shares times the current price. So, will I increase the investment? Yes. Did I get a
Yes.
gain? Yes. Right, so they talk about a gain or a fair value adjustment because it's something that has happened, right? You haven't received the 13,000. You're just holding the investments. Right? Unless you've actually sold your investment, you're not going to receive any cash. So notice there's no bank here. You're going to increase
Okay.
the asset because the value has increased, and you're going to increase the income because you've received more benefits. Remember the definition of an income? We spoke about that last week, basics. Increase in benefits. Have I
Yes.
increased my benefit? Yes. My investment
Yes.
is worth more now than it did in the past. Okay. Are you going to show the 100? Are you going to show the 10,000, or are you going to show the 13,000, or are you going to show a different amount? What amount would you show here?
I would show 3,000.
Very good. Yes, good. You show the increase because notice this is going to be either increasing or decreasing. So initially you had 10 here. Okay?
Yes.
If I add 3, all right, the total is 13.
13.
Right. Can it decrease?
Okay.
Of course it can. What happens now? Let's say it's now 80. Okay, those 100 shares now went to 80. Now it's worth 8,000. What am I going to do? I'm going to subtract 5. Does that make sense?
Yes.
Okay, because now we're sitting with 13 because of the 10 plus the 3. Now it's gone to
Yes.
80. I'm going to decrease it. I'm going to increase my expense. I'm going to show a loss on fair value adjustment. Okay, fair value. Fair value just means, fair or market value just means you have a willing buyer and seller. Right, so what are you willing to pay? Okay, and what is someone else willing to sell it for? Right, that's how the market works. All right, so buyers and sellers in a market have a fair value or market value. And that fair value or market value needs to be accounted for when you look at these types of instruments. Okay, financial instruments have to be accounted for according to their market value. Right, so credit the investment, debit the loss if it has decreased in value. Okay, so far so good. Are you okay?
Yes.
Great. All right. So this I looked at last week. I spoke about it a bit this week as well. We spoke about profit, and we looked at the disclosure. Where do you show profit? Do you remember?
Are you asking me which statement?
Yes.
Statement of comprehensive income.
Good. Okay. So when you show profit, profit is shown or disclosed in the statement of comprehensive income. When we saw that last week, we saw the format. You had sales. Okay, then you had cost of sales, and then you had gross profit. Remember that. And then you had other
Yes.
income, other expense, and then you had net profits.
Yes.
Right, that's the linear way of doing it, and that's the disclosure in terms of IFRS. Okay, so if I'm representing information in a particular format, okay, the layout, the format, the disclosure, it needs to be like that. But when you look at closing transfers, you don't use the format, you use the ledger accounts, you use those T accounts. And that's why you have the trading account and the profit and loss. All right, these two accounts are important, but this one is more important. Okay, profit and loss. When you looked at a sole proprietor, who gets the profits?
The owner.
Exactly, good. There's only one owner, remember that?
Yes.
Okay, so when you get to partnerships, you'll have the same account. It's still a general ledger account. You won't call it profit and loss though, you'll call it appropriation. But again, this is covered in other slides, okay, topics later on. All right, so I'm just showing you that you don't need to, let's say, relearn, okay, your profit and loss. Okay, if you know how to work out profit and loss, you'll know how to work out the appropriation account because it is the same as a profit and loss account. There are other things to consider, but that's specific to a partnership. But the basics stay the same. So when you draw up a profit and loss account, a general ledger account, you'll obviously have your income on the credit side and your expenses on the debit side. Okay, because you're closing those accounts. Right, I remember you
Yes.
asked me earlier about the closing off of the account. So I want to show that to you here, just so it makes sense, because you need to look at both sides. Okay, so this is the P&L, okay, profit and loss. Okay, I said income will always go on that side, and I said expenses will always go on that side. Why? Well, remember, it's a closing transfer. What balance does an expense have? Let's say I'm talking about stationery.
Okay.
Stationery has what
You have a
balance?
debit. A
Good.
debit.
Okay, so if the stationery amounts to 10, okay, how do I close this account? I would
You
close it off to
credit
profit
it.
and loss. P&L will go here, and I'd write down 10. And then on this side, I would write down stationery, and I'd put 10. Do you see that?
Okay. Yes.
Okay, that's how you close the accounts off. Same with income. Right, what type of account is income? It's income, right? I should
Yes.
have specified. What type of account is sales?
Income.
It's income. So to close off sales, it would obviously have a credit balance there. Let's say it's 50. Okay, to close off the 50, you would debit this
it.
account. So you'd have trading account here. Trading account 50, and then in the trading account, sales will go on this side. Okay, the income. Income always goes on the credit side because income is a credit. That's why the rules stay the same.
Yes.
Income must go on the side. Sales must be on the credit side of your trading account. Other income. Let's replace the word sales with something else. Let's say I didn't have sales and I had, let's say, interest income or discount received. Doesn't matter what it is. Okay, let's just write down interest income. Okay, what balance will interest income have? A credit balance. To close off the interest income, I would debit the account with P&L, so profit and loss, and then in profit and loss, I would show interest income. 50.
Okay.
Okay, every debit has a credit, always. Right, even for closing transfers. Right, you're referencing things in different accounts. Okay, makes sense.
Okay. Yes.
All right, don't worry too much about T accounts. We'll only look at them later on if we need them. Okay, if we need them, we'll use them because they can be helpful. They can be useful in certain scenarios when I need to actually work out something that's unknown. Right, you should know what the difference is between perpetual and periodic. Can you summarize it for me? Let's see how much you can remember. Describe this system for me.
So perpetual is continuous. So I know an example. So if I'm selling cars, every time I sell a car, I minus it off my books, basically.
Yes, correct. Good. Yeah. So with inventory, 100% correct. Perpetual, never ending. Cost of sales every time you have a sale. You're right. So when you record the sale, you have to associate the cost of that sale. So you'll need the cost price plus markup equals selling. Because every item that's sold, this needs to be accounted for as part of cost of sales. Right, can you describe this one?
Periodic is more like SPAR, basically. So you always selling, so you'll always be doing like stock take.
Yes, good.
For it. So yeah.
That's the word that stands out, especially when you look at periodic. The stock takes. In other words, the closing stock and the opening stock. Right, it's done on a collective basis. You're not monitoring individual items, you're just counting all the items. And you're only doing it periodically. So maybe at the beginning of each month, once a month, maybe twice a month, depending on how often you can actually count and check your stock. Right, there won't be any cost of sales because cost of sales is calculated using a formula. Okay, do you remember the formula for cost of sales?
Opening stock.
Yes. Plus?
Plus purchases.
Yes. Minus?
Minus purchase returns.
Good. Including any other additional costs? You also have to add, add other costs like carriage and purchases.
Yes.
And then minus what?
Closing.
Very good. Yeah.
Stock.
Good.
Yeah.
Okay, so you've got it. You still remember it. I think there might even be a note about it. Yeah, here's it here. All right, there's it there. Okay, what system is this using? Periodic. Why is it using periodic? Because of the vocabulary. Right, there's a reason why there's a color coding. Right, periodic, purchases, purchases, purchases. Right, you also have inventory, but inventory is specific. Inventory is either closing inventory or opening inventory.
Okay.
So when you look at a question, this they also won't cover, but you need it, right? You need to be able to identify when it's periodic, when it's perpetual, and then you need to be able to account for those different things in a particular question, right? When you sell stock, same as before, you're either debiting bank or debtors, depending on whether it's cash or credit, and then you'll credit the sales, right? Will you have a cost of sales? Not for periodic. It's done later on when you do the stock take. And there's the formula. As you said it earlier, okay, opening plus purchases minus returns, other costs, so carriage and purchases, maybe import duties and other, and then minus the closing balance. This is calculated in the trading account. You can do it in the trading account, or you can just use the formula, right? It's better to use the formula because when you disclose it, you can just disclose it as a working, and then the working will show it in brackets like that, right, in a disclosure question. We're not going to draw up tier counts. Right, that's a little bit too much in a disclosure question. You don't need that level of detail because remember, financial statements are taken from the trial balance. So the trial balance will have all these different line items. It'll have purchases, it'll have the returns, it'll have anything else, and it should also have opening and closing balances. And that's it. Okay, we've covered everything. This was just that slide that I showed you last week, just to highlight some of the more important points. So when you go through the actual study guide and you look at different questions that they've given you, you will see different FAC 1502 concepts being tested, but none of it would have been covered in 1601. All right, so these are the more popular ones. I'm going to quickly give you a chance to look at them. Are there any points up here that you're not so sure about? These are things that you would have covered in 1502. And a lot of it we've actually looked at already from last week and then obviously this week.
Gain on fair value adjustment.
Yes, yeah, the gain on fair value adjustment came from today. There's it. No, this page. Where is it? Lost my spot. Here's it.
Okay.
Right, remember we talked
but
about
why
shares?
Why is it on a debtor?
Sorry, why is it on a
Debtor.
Where do you see debtors? No, these are columns for assets.
Oh,
That's the asset column.
Okay.
That's the liability column. That's an income column. That's an expense column. All of these are assets. All of these are liabilities.
Okay.
All of these are income. All of these are expenses.
Okay, because I was so confused.
Oh, okay. You were reading it
the
like
other way.
lengthwise. Not
Yes.
lengthwise. What's it? Row by row instead of column.
Yes. Okay.
Yeah, no, it's column by column. Okay, let me change the format of this slide actually. Let's change the color. Okay, these are assets. Are assets good?
Yes.
Yes, they are. Okay, liabilities?
No.
They're bad. Okay, they're important for financing, but they're not good in terms of wealth or value. Right, income is good.
Yes.
Maybe I shouldn't use the same color. We'll just use a different one, whatever color we have. Let's use blue. And then expenses, let's use orange. Okay. All right. Is that better?
Yes.
Okay. Let me just change this as well. Okay, yeah. So these are just some of the more popular ones that you'll see. I hope you're familiar with most of them. And now that we've gone through kind of like a crash course of 1502 in like 2 weeks, or a week and a bit, this is important. This is knowledge that you should have from before that will now build on going forward in terms of disclosure. Right. I will cover specific sections. The one that I've highlighted, depreciation is a big one. That's important. The red is important. Debtors, important. Prepaid, accrued, income received advance, all of that's important. On hand, important. The others you'll see, but not as often. Okay, the ones in red are popular. That you'll probably see even maybe in the first example that we'll look at just now. Okay.
Okay.
All right. So let's save that. I'll save it as is with that change. And then let's look at your Okay, so I'm going to create a file for you, and then I'll send this to you weekly, and then you can check what we've done. Okay, so financial accounting. Ooh, I had cap locks on. Financial accounting. Right, 1601. I'm just going to call this additional notes. Okay. Right, so let's have a look at the first section that you've been asked to cover. It's a nice short section. Here's your study guide. Okay. Let's scroll further down. Let's look at where it starts. Okay, yeah, see, here they're even telling you how important fac1602 is. Have a look at that. All right, there's a little note. Basic principles, collecting and processing accounting information, knowing the difference between current assets and non-current assets, current liabilities, non-current liabilities, and then important, the reporting. All right, so this is just Eunice's note telling you how important FAC 1502 is, because you need 1502 to do 1601. A lot of those concepts are covered later on. Have a look. Okay, see, they're even referring to volume 1. And you sure they didn't prescribe it last semester, hey?
They did not prescribe it last year.
Yeah, that's that's strange, because I'm looking here and I'm seeing volume 1 here. But yeah, I know we had some issues with the assignment. Sometimes Eunice is not so good with their updates, I guess, or
and they actually moved our date for assignment 1.
Okay, so you're ahead of time rather than on time. That's very good. Good for you.
But they moved it yesterday, so I don't know.
Oh, they moved it yesterday. Wow. I thought they would have given you maybe 2 weeks or 3 weeks, but sure, that's still early in the semester, yeah. Okay, but you submitted last week, didn't you?
Yeah, because that was the date that they gave us.
Yes. Okay, so you don't have to panic about that. Your assignment is in, and you'll obviously have access to your exam. All right. How's your VATs?
Yeah.
Can you work out VATs? Do you know the calculations for VATs?
15%?
Yes, percentages. Let me check. I'm going to test you quick. Let's see how good you are with VATs. Grab a calculator or your phone if you don't have a calculator close by. If I give you 300, can you get those missing figures? VAT is obviously 15%, right? What are the missing answers?
Okay, so... But VATs include...
Sorry, say that again. VATs excluded here.
Hold on.
300 is the VAT exclusive amount.
So 45?
Good. And then?
And then 345.
Correct. Okay, so let me write down the formula in case. Right, to work out VAT when you've been given VAT exclusive. Right, you multiply by 15 over 100. Right, that's it. Right, let me do it this way so you have the question as well. Right, can you do this? Let me get one that works. Okay, this one's a nice one. This will work out. Okay, if I give you this, can you work backwards? Okay, you can work forwards. Can you work backwards? What's the VAT exclusive?
Ooh, okay, wait. 1 second.
If you need help, let me know. It's fine.
I know I did it before, but now I'm because I can't change the formula. So it's 1035.
How do we work backwards? Do you remember? Struggling a bit?
Struggling a bit.
Okay, so there's the formula. Right, so you want the VAT exclusive. Remember, the basic general formula for VAT is 100, 15, and 115. Right, so when you look at VAT, VAT is treated like a ratio. Right, the ratio is as follows, 100, 15, and 115. So if I want the VAT exclusive, okay, I'm going to have to use the ratio. Right, what do I have? I have the inclusive. The inclusive represents 115.
Yes.
Okay, that's what I've been given. All right, so if I want the VAT exclusive, I need to multiply by what I want, which is the 100. The 100 represents the VAT. Okay, so the VAT exclusive is what I'm looking for. What do I have? I have the VAT inclusive, and I've got the ratio. There's the ratio. Right, that is the formula. You can
Okay.
study the formula as is. You can use it as is. If I copy paste it and I'll put in the amount, okay, what do you get as an answer? 10?
So 900.
Yes. Okay, happy.
Yes.
How do we get the VAT?
You can either minus it or you can do 15 over 115. So 135.
Yeah, you could work it out as a fraction if you want to, kind of like what we did earlier, but I would just minus instead of overcomplicating it.
Okay.
Right. Another formula that you need to remember, VAT equals VAT inclusive minus VAT exclusive. Right, that's the one that I actually used here.
Okay.
Okay, and that's pretty much it. As long as you've got one to work out VAT based on exclusive, and as long as you've got one to work out exclusive based on VAT inclusive, you can get all the other figures. Right.
I think the ratio one's actually easier if you just remember it that way.
Yeah, this
instead
is
of the
what
formula.
I've used. There's actually a video about it, but I think the video is a bit outdated now because I think I did it before 2018. So I think on my video, I actually need to make a new one actually, thinking about that. I think I had 14% in that video. Yeah, but there's a YouTube video somewhere on YouTube, on the website, that talks about the general equation or general formula. And you can use it for anything. I don't have to use it for VAT. I also use this general equation for cost price markup and selling. Okay, I call it the given 1/2 formula. Formula. All right, and then I can also apply it to this. Copy paste, cost price, markup, and selling. Okay, let's say the markup is 50%, and that'll be 150. It doesn't matter what the markup is. Right? The markup can be anything. So if markup on cost is 50%, well then it's markup over cost price. So it's 50 over 100. Okay, there's the 50 over 100. So the selling price would be 150. And then if I give you one of the amounts, you can work out the other amount. Right. That's not so important for 1601 because they don't often give you cost price markup and selling. Right. The VAT, that's probably more likely to come up because they've mentioned it here. Okay, but yeah, it's just a general
But
formula.
you can get a markup on your selling price, right?
Pardon?
You can have a markup on your selling price.
But then it's not called a markup on selling price. It's called a gross profit margin. Gross profit margin is gross profits. Gross profits margin, okay, is gross profit divided by selling price. I think that's the formula you're looking at. Times 100. That's the percentage. That they might have covered in 1502, I think.
Okay.
A markup on cost is what you use for cost price markup and selling. Okay, you don't mark up based on selling price because remember you need a base.
Okay.
So the base is the cost because you're
Yes.
adding to the cost. It's not selling price plus markup equals what? You don't get something like that.
Yeah.
Okay, you don't mark up your selling price. You mark up your cost. Does that make sense?
I get you.
Yeah. So markup on cost means the base is 100. Okay, and then the base is added an amount. Okay, so 50 in this case because I'm marking up my cost by 50%. Right, this does come up in some areas, okay? Gross profit margin, but that's a different formula. That's gross profit over sales. That's what I thought you were referring to when you spoke about markup on sales. No, you don't have markup on sales. It's markup on costs. It's gross profit on sales. Those are the two different formulas.
Okay.
Okay. All right, let's go back and
Okay.
look at the textbook. All right, so that seems to be fine. Depreciation, we did a bit of it in the assignment. We'll do more of it when we get to practical examples. Right, notice they're highlighting things that you need to remember. Credit losses, we spoke about. Do you remember what this is? What type of account? I just want to test the account.
Expense.
Good. What type of account is that?
Negative asset.
Very good. When you have a settlement discount that's granted, what type of account is it?
Expense.
Good. Okay, you give out discounts, so you lose the benefit. An allowance for discount granted, it's the same as allowance for credit losses. Right, you're providing for something bad. A settlement discount that's granted is an expense. A credit loss
Yes.
is an expense. So whether you're providing for an allowance on a credit loss or whether you're providing for an allowance on a discount that's going to be granted, it's still a negative asset.
Okay.
Okay, settlement discount received.
Is an income.
Good. Okay, then inventory, we looked at it a bit today. Perpetual and periodic. You'll see your study guide's even asking you to go
Yes.
back and look at it. Make sure you know the difference between perpetual. Make sure you know the difference between periodic. Okay, I will go through it when we do practical examples. Right, and then they're looking at inventory valuation, FIFO. Okay, a little note there about the costs. Right, this is more management accounting. Right, remember, UNISA has lots of different modules. The MAC modules,
Yes.
you're doing the FAC modules, the FAC. FAC is financial accounting.
Yes.
MAC is management accounting. Management accounting deals with this in more detail. There you look at things like costing, okay, pricing, actual FIFO, LIFO, and more of this. Okay, this they might have mentioned in the past, but it has never ever come up in actual questions. Okay, and especially not in 1601. I've never seen this come up in 1601. All right, this is just learning outcomes. That's fine, that you can go read through if you need to. Okay, now we're getting to the good detailed bits and pieces of knowledge that you need for different sections. Right, we've only got 9 units to get through. You'll see in my notes that I've given you, there's actually a few extra units because this course was a lot longer in the past. They've actually made it easier now because they've taken out other things. There used to be an analysis section, but that's gone. And there used to be one other one as well, I think, which is also gone. I forget what the other one was. But there were more units here. But they've kept the core units as is, which is fine. And these are the more important ones anyway. So you've got a nice layout here in terms of scope. I'm going to be looking at study unit 1 this week. Okay, depending on how fast we go. Remember, it's more of a private lesson than a group lesson. So the speed at which we get to the content is based on you. So if you're coping well, and I can see you're coping well, then we could even do more each week. And the sooner I get through all 9, the better, because then we'll just have more time to do past papers. All right, so it's really gauged on you in terms of your progress. Right, so I'm looking at your progress and I'm saying, well, are you understanding everything? Are you happy with everything? If you're happy, I'm happy, and then we can move on. All right, so I'm just saying that now up front, so at least you know that we've got more than enough time and we've only got 9 units to get through. But some are easy, some are a bit more difficult. Right, as long as you're keeping up and you're understanding everything, that's important. Right, and you can always go watch this again if you need to, because you'll have it if you need it. But remember, tell me if you're not understanding something. Stop me if you're not understanding something. Rather, let me address it when we're covering it than later on. Okay? And because it's just the two of us, I can address your topic specifically, and I can spend lots and lots and lots of time helping you with what you're struggling with. Okay? All right, so that's the scope. This week, if we can, we'll probably do a bit of 2 as well, but we'll see. How are we doing with time? Oh, we're doing very good with time. We're doing fine. All right, don't worry about this. This is just the way they test you. Okay, you'll see some of these words in different questions. Cash transactions we spoke about last week. You do need to remember receipts and payments. Okay, CRJ, CPJ, remember that?
Yes.
Okay, you'll never have to do a bank recon again, so don't worry about that. But cash is important for cash flow. Very important for cash flow. So you need to know when money comes in, when money goes out, and where to find bank. I've mentioned how important that is. Okay, T accounts. We're going to use lots and lots and lots of T accounts to find the cash flow and to calculate and interpret the transactions. All right, and then that's just basic admin, and there we go. Okay, we've reached it. Learning unit number 1, Introduction to the Preparation of Financial Statements. Right, let's have a look at the content. What is UNISA giving you to go through? Okay, they've spoken about IFRS. I looked at this with you last week. Quick summary. Can you tell me what IFRS deals with?
It's the international frame of something. So basically, the way in which we disclose things,
Very
the
good.
rules
Yeah,
and
that's
the
important.
principles. Yeah.
You're never ever going to be given like detailed theory questions explaining the conceptual framework, only because it's practical, right? But remember, if your test is going to be done online, was your test multiple choice last semester when you did 1502?
Yes.
Or multiple choice?
Because it was online. Yes.
Okay,
Everything
so they
was
didn't give
multiple
any
choice.
written questions.
No.
Wow, okay, so you might be lucky this semester again and you might have everything online multiple choice, then that can help a lot. But the only problem with multiple choice is there's no working marks. You either pick the right answer or you pick the wrong
Or the
answer.
wrong. Yes, because actually the exam last year was actually really, really difficult.
Okay. When you say last year, you mean last term?
I mean, sorry, last term, because
Yes.
what they did was they had questions for 3 marks, 2 marks, and 1 mark.
Yes. Okay, so that's how they've
So,
done it because of COVID, obviously, lockdown and all of that.
yes. So if you got a 3-mark question wrong, that was it.
It makes a big difference.
Yes.
Yeah. Yeah, so you have to be careful. Did they give you 2 hours or did they give you more time?
No, they actually gave us 1 hour and 25 minutes.
Wow, they gave you less time
Exactly.
because these papers are
So that's
normally
what I'm
2
saying.
hours.
So it was really, really
It's
something.
hectic, yeah. Wow. Okay, so yeah, quite a few changes. It'll probably be the same. Remember, you're only writing in I think it's November. So unless we go to level 1 or unless the lockdown completely falls away, who knows what they're going to do? They might have a written paper stashed away somewhere because normally UNISA does the planning for this year, but they did last year. So it's always done a year in advance. And then they obviously change and update things if they need to. But that's kind of how these institutions work. Right, so if you do write a written paper is actually better. And you'll see when I do
Yes.
questions, I do it all written and then I just go choose options. Even like the assignment. The assignment, I could have done all of it and then just go pick answers. But I try to keep it focused on what was being tested because I know you haven't covered any of the content yet and it's right at the beginning of the semester. So if I did too much, I think it might have overwhelmed you a little bit. So I try to keep it specific, look at each question and then just cover that. But you'll see when I do assignment 2, I will do the whole thing and we'll just pick answers in that because then we would have covered more. You said they gave an extension for assignment 1. Did they give an extension for assignment 2?
Ooh, I have to check.
Okay, yeah, don't worry. You can always check later on. It's not a problem.
I'll check.
Let me just
Yeah,
see
and
if
I'll
I
send
did
it
I
to
make a
you.
note here when assignment 2 is due. Let me see. Okay, not on my printed calendar. I'll have to check my digital calendar. But I did make a note somewhere about the assignment. I think we have to do it in week 4, week 3. No, not week 3. Well, 3 weeks from today, I think, or something. But I'll go check. I'll check it and see. Okay.
I can check.
I can actually open it quick. Let me open up the assignment. Let's see here. Let's see when the next one's due. Let me write it on my written calendar. Let's just see here. There's semester 2, but I'm looking at assignment 2. There. No, that's number 10. Here's it. Okay, 8 September. Wow, that's soon. Yeah. 3rd week, eh? Yeah, so I still have next week with you, and then the week after we'll look at it.
I'm just checking quickly if they changed it.
Yeah, so not this week, not next week, the week after. The 8th. Have a look. 8th of September. It's a Tuesday as well, so I'll do it the same as before. Okay, I think I'll probably send you it
They
in
moved
advance.
it.
Oh, we
So they
can gauge how
moved
it
it.
goes, and we can see how it goes. I might have to send it to you in advance again, and then we just discuss things that you might not know, and then we can always go back and look at it later on, if you need to.
Anthony,
Yes.
they moved it to the 21st of September.
Oh, okay, that's even better. Then we'll be able to do it later.
So assignment
Okay, so
one
I'm going
is
to cross
actually
this
due now on
out,
the
and I'm going to
3rd.
write it down for the 21st. But then
Yes.
we can probably do it on the 15th, so that gives us an extra week. Okay, so I'll cover
Okay.
that one with you on the 15th. Okay, and then at least then you've got a whole week before the 21st to submit it and to go through it and to see. Okay, yeah, that's good. That gives us time. Perfect.
Yeah.
All right, thanks for
Okay.
confirming that. So that date has changed. At least they've given you quite a nice extension there.
Yes.
Okay, coming back to this, the rest is fine. As I said, you're not going to see detailed questions looking at conceptual framework, but if it's multiple choice, the reason why I was asking you about multiple choice is because I've seen short questions covering this, but only as multiple choice questions, not in a written paper. That's why I was asking you if it's written. So, for example, if you look at past exam papers for 1601, I've never seen this come up. But the reason why I asked you about the online MCQ, it's because it's obviously locked down and they're going online, then you might actually have some of these questions come up.
Because for 1502, we actually didn't. So we still did like, how would I give you an example?
Long questions and then
Say
ask you to choose the right option.
Yeah, so say if you did, like if we did a statement of comprehensive income,
Yes.
15 would be like what it would be your gross profit.
Yes. Okay. Yes.
And then the next question would be like maybe expenses or whatever
Yes.
the case might have been.
Okay. Yeah,
So
it makes sense. So they're still wanting you to do all of it and then just choose options. Yeah. All right. So this
yes.
is just for a maybe. Okay.
Yeah.
Maybe they test it or maybe they don't. But if they do test it, it'll only be in a short question. It shouldn't be in a long question.
Okay.
All right, so that I'm going to skip over a little bit. This you actually saw in my notes. We spoke about the qualitative characteristics. Hopefully, you're okay with this principle.
Yes.
Okay, how is income recorded?
When it's earned,
Very good. That's important. And expenses?
when it's incurred.
Very good. Okay, so notice you don't have to pay it. You don't have to receive it. All right, it's based on the accrual basis. All right, so from now up until cash flows, everything I do with you will be based on accruals.
Accrual.
Right, only when
Okay.
we get to cash flows will we then talk about receipts and payments. Up until then,
Okay.
don't worry about it. Just think about earned and incurred for income and expenses, and you're always looking at 12 months. Okay, there's a little note there about disclosure. IS1 is disclosure. Here they're talking about definitions. Very important. That I'm going to stress. Okay, we saw it last week. There's Eunice's note about it. Okay, you do need to know what the different accounts are: asset, liability, income, expense, capital, drawings. Those are the 6 most important rules. Those are the 6 most important definitions that you need to be able to explain and define for different things. Okay, for financial assets or financial liabilities or other, doesn't matter. Okay, these are just some of the ones they've given you here. It's probably covered later on in the chapter as well. Okay, some key concepts to look at. I think those you're okay with. Again, it's more theory, no practical there. Right, introduction, you can go through this. I'm not going to read through this. I'll just highlight a few things that we've spoken about before. This is something to highlight: financial information. Okay, remember we started by asking the question, what is accounting? Accounting is just that. It's generating financial information for users. Right, so if you keep that in mind, when you look at questions, you will draw up different statements, and those statements are for different purposes or reasons. Right, those are the different statements. Cash flow statement, changes in equity, comprehensive income, financial position. There are only 4 separate financial statements. And when you do practical questions, the ones they like, this one, Oh, I can't highlight. Let me just circle. This one, those ones they like. This one as well, but only for certain questions. Okay. Cash flow, definitely, but it's a separate section. Okay, it's not disclosure. You won't see all of them in one question. You'll see these three together, potentially, all right, and then you'll see that one on its own. Okay, cash flow is very, very, very separate. All right, they talk about the rules, the SA GARP, that's just background. They talk about the accounting boards and how South Africa went in line with international financial reporting standards, a little bit from last week, actually. We mentioned some of it. Here's a note about recognition. That's important. Measurement, also important. Right, NB. Why? Okay, this is a tip. When you look at different questions, always scope out the question and decide what section is UNISA testing. Right, is UNISA testing property, plant, and equipment as part of a disclosure question? Is UNISA testing goodwill? Is UNISA testing a liquidation? Is UNISA testing disclosure for a partnership or close corporation or company? Right, so you need to be able to recognize the section. In other words, what chapter are they actually asking me about? Because if you get the chapter right, then you just need to apply what is relevant to that specific chapter. Right, and you'll see how I do it when we do past papers. Okay, I'll show you the exam technique. I'll show you how to actually do it. I'll do it with you, and I'll take you through the questions like it was an exam. Okay. All right. That you don't have to stress too much about IFRS. We said it's the rules. Here's a note about conceptual framework. This is all theory that I'm going to skip over. If you have questions about it, you can always ask me. But it's theory. Okay. If you've got the textbook, the volume 2. Let me just see. Where's my volume 2? It's on the bookshelf there. I don't have to go search for it. Yeah, I've got an older version of volume 2. You've probably bought the most recent version. The conceptual framework is probably covered there in terms of theory. But again, not so important from an exam point of view if the exam is practical and they're asking you worked examples. Right, when you look at worked examples, you're adhering to the conceptual framework. You're following the standards. You're following the disclosure. You're following the layout and the format and so on. Right, and that's pretty much what they're describing here in terms of the reporting. The concepts, the principles, and the reporting. Okay, let's see if there's some practical questions we can actually do. Let's see. Okay, this is again theory. True and false. Communicating financial information. We know it's a language. We know accounting is important for business because it helps you to make decisions in different subjects. It's the basis for decision making that comes later on in other subjects. Here's a note about the financial statements. They've given you a list there. The notes are also important. The only note that you've actually looked at before is property, plant, and equipment from FAC 1502. Do you remember that note?
Yes.
All right, that's a note that could come up in terms of disclosure. I don't think it will come up because it was tested in 1502. Right, but it's something to consider in more detailed questions relating to certain specific accounts or businesses. All right, objectives we've seen. We know that the objective is to present information so people can use it to make decisions. That's important. Decision making, we spoke about that last week. And then they show you a few other things. They talk about some loans here. I see there's equity here. They talk about interest. This is something worthwhile. This can come up. Do you remember your formula for interest? How do you calculate interest?
So it would be your, say example, a loan.
Yes.
So whatever the cost or the loan that you took.
Yes.
Times the percentage that you're paying.
And then? You're missing something. You said the loan amount. So the loan amount is called the principal.
Okay.
You said you times it by the rate. What else?
Yes. Oh, and then the period. So
yes,
2 years, 3 years. Okay.
Yeah, that you need to know. If you've got your book with you, you could even write that in if you want to. But that's something you need to know when looking at interest calculations. That can definitely come up. Interest is principal times rate times time. The time element is because of pro rata. Remember, pro rata means part of a year. So maybe 2 months out of 12, 3 months out of 12. Right, the same applies with depreciation. Depreciation can be prorated, okay, or prorated, I should say. I think that's the right term. Same with interest. Interest can also be prorated because you have part of a year, not always the full year. All right, so make sure you have that as a note in terms of calculations. Interest is calculated based on principal times rate times time. The rate is always a percentage. Time will be a fraction if it's part of a year and not a full year. Okay, here they've just given you some notes about different users. That's fine. We actually looked at that last week. Here they're talking about the conceptual framework again, and they look at the preparation. Right, this subject is very practical. So when you look at this section, you need to use those templates to try build a set of financial statements. And those financial statements need to be based on the rules. Okay, the concepts, the theory, the principles, all of that recording that's necessary. Right, and that's what they're describing here. Okay, what else do we have? Okay, there's the characteristics. Okay, we saw that earlier actually in the learning outcomes. And then they're asking us about reporting. Reporting, cost, management accounting, okay, financial accounting is what you're looking at. This is disclosure from a statement of financial position point of view, statement of comprehensive income, statement of changes in equity, and statement of cash flow. Right, management accounting is internal and it's more detailed. All right, there you look at more detailed reports covering costs and other. Right, but those are the two different subjects. You might have some Mac modules actually. Sorry, I didn't get that.
Why don't I do Mac modules?
It might be a selection perhaps. If it's not part of your syllabus and if it's not something you can select, then you probably don't have to do it. Yeah, but there are different modules. UNISA does have Mac modules. They've got FAC modules. And then with FAC, then as a prerequisite, then you've got the FIN modules. And then with the FIN, you've got the I and V modules.
Yes.
Right. So
who would do Mac?
Pardon?
Who would do Mac modules?
Who would do Mac modules? Management accountants.
Yes.
People studying business management. People doing operations management. It's more internal. It's not so much external. And Mac is looking more specific at costs. So allocating costs, absorption costing, marginal costing. There's a lot of different costs that are covered in that module.
Okay.
Yeah, but you want to do more finance. Yeah, so finance, you might actually do some of it in finance, but not that much. Okay, Mac is its own subject. It's management accounting.
Okay.
Yeah, so if you don't have to do it, then you don't have to worry about it. Don't stress about Mac if it's not necessary. Okay.
Okay.
Perfect. Let's have a look at what else we've got. Okay, there you go. Characteristics again. What makes the financial statements brilliant in terms of their disclosure? Okay, remember you want quality financial statements. The better, the easier it is to make decisions. Okay. Elements, looking at the different sections, you can see even here they've talked about those rules. Now you know why I've stressed it so much. Assets, liabilities, income and expenses. Capital and drawings, here, equity. Okay, there they could have expanded on. They could have written capital and they could have written drawings. Okay, you've got a note on this, so you can just look at the study notes. You don't have to worry about this. I'm just going through everything, so we've got it. Definitions. Here's the textbook definition. See it?
Yes.
There's assets, there's liability. It comes from IFRS actually. Okay, let's see what else we've got here. Recognized in the pro financial statement. Okay, this is something I can test you. Where do you show your assets? Which statement?
Financial position.
Correct. Liabilities?
Financial position.
Good. Income?
Comprehensive income.
Yes. Expense?
Comprehensive. Yes.
Perfect. Good. Right. The measurement we'll see when we actually do practical questions. Here they talk about, obviously, cost is important because that's based on what you had purchased. It's the cost price. That relates to both property, plant, and equipment. It relates to PPE, PPE, and inventory. Okay? The realizable value relates more to inventory than to PPE. A revaluation? I don't think you've done a revaluation, hey?
No.
Yeah, revaluations only come up in PPE, and we won't look at it in PPE. We'll look at it when we do valuations, and that'll be part of partnerships. Okay, in a partnership, you do something similar to a revaluation, but they don't call it a revaluation. They call it a valuation, right? There's a valuation account. Remember earlier I spoke about working accounts?
Yes.
Profit and loss, realization. A valuation account is a working account. That will only come up in partnerships. Okay, you've got a note about capital here. I think that's fine. That's theory. IFRS, we know how important that is. That's theory. Nothing important there. All of this is theory, looks like it. Theory. Purpose of financial statements, making decisions. Considerations, going concern, again, characteristics they're describing here. Structure and contents, this I can put a little note next to, NB. Okay, this is formats. Right, the nice thing about having an online test is you have all those templates and you can use all of those things to help you. So my advice ahead of time as a tip, if I was you, even though it's online, I would probably do it on Excel. And you'll see when I do it, you'll see how easy it is to actually do it. I don't know, how good is your Excel? Do you like Excel?
Yeah.
You do?
I think I'm fairly
Yeah,
good
it's
with
actually
it.
quite simple to use and it's very quick. You don't have to worry about adding and subtracting and minusing and multiplying and all of that stuff. You can do it in Excel. So if I was you, I would try do it on Excel and I would try use some of the templates that we'll use later on when we actually do questions, because it's quicker, it's faster, you can save yourself some time in the exam, and even if you make mistakes, you can just literally delete and update and change. Right, so it's quite a nice, let's say, improvement, okay, if you are considering the exam technique or the actual writing of these exams, because it's online, at least then you can make use of technology to your benefit. And I would definitely recommend using this. Okay, statements, you've got it here. If you still don't know what this is, you can have a look at this paragraph. It's describing what is being disclosed in the financial position. Here, they've described the profit and loss and other comprehensive income. Okay, again, it's theory. Go look at this, read it if you're not too sure what this is. I'm going to show you these disclosure statements later on when we get to questions that have workings. Right, SOCI, Statement of Changes in Equity. This is nice because they've mentioned something important here. Movement in equity. This one is important for the partnerships. Because when you're in a partnership, you have to value the partnership. And how is a partnership valued? It's based on the equity that each partner has in the actual partnership. Because remember, partners are separate, but they're together in the eyes of the accountant. Right, remember, a partner is separate because, let me ask you this. How much, what's the right topic? Business management have you done? Do you know the forms of ownership?
Yes.
You do? Okay, so can you tell me what the difference is between a partnership and a company?
The number of members.
Okay, yeah, well, a company wouldn't have members. A company would have shareholders.
So the number of, yeah.
Yes, you're right about that. Can you tell me more about the partnership? Give me some characteristics of a partnership from a business management point of view. Okay, let me guide you. Is a
Yeah.
partnership a separate legal entity?
No.
No, why not?
So they have unlimited liability.
Very good, yes. Okay, you know it. Right, so because they have unlimited liability, a partnership means A and B are separate, okay, in terms of being individuals. Right, so in the eyes of the law, okay, they're not seen as being one, inverted commas, business. They're seen as two separate individuals working together in one business. Does that make sense?
So you're saying that they have separate
They have separate everything.
Okay.
So imagine this. You're an individual, I'm an individual. Okay? We decide to start a business and we're going to form a partnership. Okay? My
Yes.
assets are my assets. Your assets are your assets. But whatever we do in the business, if we sell something, okay, half of the sales will be mine and half of the sales will be yours. Does that make sense?
Yes, but then wouldn't it also be if you run a loss? They're
Half of the
personal. Are
loss
you
is
talking about
yours, half of the loss is
personal?
mine. You're right. So your question?
Is that, are you saying that they're separate from each other or are they separate from the business?
The partners are separate from each other.
Okay.
A is separate from S because they're individual partners. That's why when you have a partnership, you've got capital A and you've got capital S.
Yeah.
They're separate. But when you look at it from an accounting point of view, you put them together because whatever the partnership does, that needs to be separated and split between the partners. That's why they call it a profit sharing ratio.
Okay.
Okay, so remember what you said. A partnership has unlimited liability. A partnership is
Yes.
not a separate legal entity. Okay,
Yes.
what you said there, whatever you remember from before, in terms of business management, you still need to remember that because the legal
Okay.
structure is important because it affects the accounting. Okay, because
Okay.
you'll see the equity is separate, but the income is
Yes.
combined. I don't know if that makes sense
Yes.
now.
Yes. Yes. I get what you're saying.
Okay, because your
Okay.
capital is your capital, my capital is my capital. But when we work together as a partnership, okay, your
Yes.
sales and my sales are sales for the partnership. We share our sales, but we don't share our
Yes.
capital.
Okay. I get what you're saying.
Okay, so whatever you do in the partnership is split, but the partners are always separate. Always separate. All right, they're never, ever, ever combined. Right, because there's unlimited liability and there's no separate legal entity.
Okay.
Okay. All right, that's important because when we look at movement in equity, you will see that. You will see that as part of the statement of changes in equity. You'll see A separate from B, separate from C, separate from D. Okay, each partner will have its own equity in that particular business because it relates to their ownership. Right, the partners own the business. Right, cash flow we'll look at in a separate chapter. Financial statements, we actually looked at it today. I see they've given you some notes here. This is good. This wasn't in this textbook before, but I see they've included more of it now. Okay, financial assets we spoke about. Assets are assets, liabilities are liabilities. Follow the same rule. You just have different types of assets and different types of liabilities. Right, so they've given you the different examples here, and they've even repeated some. Inventory from before, PPE from before. There's a few others here. Prepaid rent. What type of
Why
account
would
is
that
this?
an asset?
It is an asset. Very good. Okay, what type of account is? Oh, okay. I see the answer. I hope you did. I hope you weren't cheating.
No, no, no.
Okay.
I'm just asking for that payable. Why is it a liability?
It's payable. Payable means it's paid over to SARS. Right. So if I did 1502 with you, I would have given you this diagram. Okay. A VAT vendor is the business, right? And you always look at things from the business's point of view. Okay. Arrow on this side, arrow on that side. Okay. This arrow is going in and it occurs when there is buying. All right. So when you have buying, you'll have input, goods coming in. When you have selling, you'll have outputs. Okay, goods going out when you sell. Right, so when you sell goods, okay, if I sell goods, let's assume we're selling goods and those goods are worth 345. Okay, the 300 is going to be kept in the business. Do you agree?
Yeah.
And the 45 is going to be given to SARS. Right, so when they talk about a VAT payable amount, they're looking at the difference between your input and your output. If your output VAT is greater than your input VAT, you are going to owe SARS. Does that make sense?
But according to the definition, it wouldn't be an obligation.
It
So
is
wouldn't
an
it be like more
obligation.
of
You're obligated to pay SARS 45. You'll never, ever, ever have it. Because think about it.
Okay.
You're getting, how much is the customer paying you? 345 Rand. How much do you
Yeah.
keep? 300. By law, this is legislation. You are obligated to pay over the VAT. And for big businesses, so businesses that make a turnover of more than, I think it's 3 million, no, it's more, 20 million. It's 1 million and you have to register as a VAT vendor. So if you make more than 1 million, if you sell whatever it is, products or services, if you make more than 1 million a year, you have to register for VAT. SARS wants 15% of your sales. If you're a big company and you make more than 30 million a year, SARS wants 15% on all of that, and you have to pay them at the end of every month. It's a monthly SARS return. It's a VAT return, actually. Okay, that they might even have covered last year when you did VAT as a separate chapter. I don't know how much theory they covered last year in your subject guide. Okay, because the subject guides look like they've changed a little bit. I know you said they didn't give you a textbook, so that would have been in the textbook, but maybe not in the study guide.
Okay.
Okay, but yeah, the point is VAT payable is an obligation. VAT payable means I've got more output VAT than input VAT. That means I have to pay it over to SARS.
Okay.
Okay. How are you feeling? You still okay? Still awake?
Yes.
Okay, not tired.
Do you want to have a 5-minute break?
Can we just check what's the rest here, and then we can take a break, and we can come back and do another hour quick.
Okay.
Right? Can we quickly go through this and see if there's anything
Yes.
else? I don't want to start a long question, but I just want to see what else they've given you here. Is that all right?
Okay. No
Okay.
problem.
Classification, recognition, measurement. We saw that earlier. This is defining those assets and liabilities. You've got it there, and you've got it there. Practical application of IAS 1 here. Now we're looking at disclosure. So there should be questions coming up soon. Yes. But this one is theory. I see some amounts here. This is looking at workings. What is the required asking for? The treatment of the sculpture, the measurement. Okay, yeah, this is theory relating to the value. Right, so remember we spoke about fair value, market value?
Yeah.
Okay, the textbook is asking you about that. Right, the change in value. Right, this is even bringing in some exchange rates. Okay, British pound and rands. Okay, here's a practical example. All right, we can stop here. These ones I can look at with you to go through them in detail. All right, let's take a break. How long do you need? 5 minutes? 10
Yes.
minutes?
5.
5 minutes, perfect. You're right. Ready to continue?
Yes.
Awesome. Okay, so when I look at practical examples, I want to treat this like an assignment question or a past paper question, so at least you know how to approach it. Sometimes the approach is actually more important than the question. Okay, this is study unit 1. Let's look at this question. Right, what stands out for you here? I think I'm going to give you the task of reading it and then tell me what stands out.
Okay, so on 1 March 2014, Lewis CC purchased 100 ordinary shares of 100 Rand each in Marble Limited, company listed on the Johannesburg Securities Exchange. The purpose of this investment was speculative in nature. The transaction cost accounted to 500 Rand on 28th Feb 2015, the end of the financial year of Lewis CC. The shares were trading at 125 Rand per share on JSE.
What stands out?
100 shares of 100 Rand each. And at the end, the transaction cost, that's 500 Rand. And at the end of the period, which is the 28th of Feb, they were trading at 125 Rand per share.
Perfect. Good. Okay, so do you know what the context is? What are they testing here?
I would say gains that we went over.
Yes. Good. All right. So what we looked at earlier. Okay, remember in the notes, you had some notes
Yes.
about financial instruments and how those values can change. Here's a practical example. Right. So how would you approach a question like this? Well, a tip. When you see dates, you need to
Yes.
highlight them. Okay, because dates will affect disclosure, especially with financial instruments, because you're looking at market value or fair value. Right, so what I'd
Okay.
like to do with these types of questions is draw a little picture. Okay, 1 March 14. Okay, and then we've got 28 Feb 15. Right, what happened on 1 March? 100
You
shares.
bought, yes.
Okay, 100 Rand each.
Mm-hmm.
So 100 times 100 is 10,000. Right, this is obviously in marble limited. Okay, then you've got the investment is speculative in nature. That's important. If it's speculative, it means you are speculating. You are expecting the shares to increase in value. Okay, speculative means you're investing or you're trading those equity instruments with an expectation. You believe that those assets are going to increase in value, right? Which did happen in this case. So they've made the right decision. The transaction costs amounted to 500. When are transaction costs applicable?
When you're talking about expenses, maybe?
Yes, that's right. So when are those expenses applicable? At the 1st March or 28th Feb?
1st March.
Yes. Okay, when you acquire those shares. Okay, when you buy those shares. Right, then they tell you at the end of the year, the shares are at 120 Rand each, 25 Rand each.
Yeah.
Okay, so have a look. That's the start, that's the end. Right, so if I'm looking at the record keeping, the accounting, what would you have to show? Well, on the 1st of March, right, what happened on the 1st of March? I bought shares. I invested in company M. Okay, investments in company M is an asset. So I would debit the asset, right?
Yes.
Investments. Investment in M Limited. In brackets, asset increase. Okay, credit. How do you invest? You use money to invest. Asset decrease. Okay, straight from the notes. Remember that?
Yes.
Okay, what do you show? 10,000.
10,000.
Right, what else are we going to show? The transaction costs.
Yes.
And you even gave me this answer earlier. When you went debit transaction costs, expense increase. That wasn't in the notes that you've got to consider. But again, just keep it simple. Think about it.
Yeah.
Okay, when you pay, you decrease the bank. You're recording expenses, you increase the expense. Right, there's your journal entry. Right, what else do I have? I've got 125 per share when at that point in time. Right, so the value here was 10,000. Do you see that? Has the value increased?
Yes.
Yes, 100 times 125. Okay, so this is a fair value adjustment.
Okay.
Right, the difference is accounted for in the financial year. And it's a gain, it's a benefit, it's an income. Right, so how do you increase an asset?
You debit it.
Good. What's the credit going to be?
I know it's gains or income. I just don't know the full word, like
You're right.
investment gain,
Gain on
maybe.
fair value adjustments.
Okay.
We'll check their answer and see if they've got the same thing, and then we can just relate it to what they've got. All right, but basic
Okay.
principles always apply. All right, this is how I would do it. Obviously, you need to cover theory. So I would use the textbook to cover theory, and then I would use the UNISA study guide to practice. Right, because volume 2 will cover all these concepts.
Okay.
That would be my suggestion. Once you've covered theory, then you need to practice. Don't practice with the textbook examples because sometimes those examples are a bit different to the way UNISA tests it. So your best practical questions to use would be these ones. The ones in the study guide and in the past papers and the assignments. Right, and we'll look
Did
at...
I send you
Sorry?
the tutorial letter? I think it's tutorial letter 102. Did I send that
I've
to
got
you?
tutorial letter 101. I've got
I think
101. You said 101. I don't have a 102.
Okay, I think I'll send you the other ones because they also gave us additional questions.
Yes, they normally do, but those have answers so that you can even go through on your own if you want to.
Okay.
And then if you have problems, we can look at it. I prefer going through the past papers because those past papers are exactly the same in terms of structure, layout, difficulty, and the way they tested is important. But yeah, we can go through those other ones if you want me to. I'm open to your suggestion if you feel that you need help with that.
Okay, but maybe I'll do those ones myself
Those
and then we can
ones,
do exam.
yeah,
Yeah.
I think those ones, because you have solutions, because the only problem with UNISA, they don't give you answers to past papers. I don't know why they don't. They should, but they don't. So that's why I try to focus my attention more on that, because then that's where the students find the most value, because that's what you're actually going to have to do in the exam. You're going to write past papers. Okay, past papers are at the right level. Some of those questions in 102 probably even come from old exam past papers.
Yes.
Okay, but yeah, we'll look at it. We can look at it. It's up to you. If you need more help with that, we can. Obviously, my objective is to get through theory, to get through content, to teach you how to do all these different sections, and then practicing can come later. You can go through examples. Even after today, after study unit 1 is complete, you can go look at all the different examples for study unit 1 and see, well, would you be able to do it? Do you understand what they're trying to achieve? Okay, by asking certain questions. Right.
Okay.
Okay, great. Let me just insert that figure. We said it was the difference, eh?
Yeah, so 2,500.
Okay, yes. There's the difference. And that's it. Let's see. All right, notice they've done it as 1. Okay, they like putting things as 1. You don't have to. This is perfectly acceptable. Any institution would mark this correct. Right, you don't have to shorten it. You don't have to combine it. Right, if you look at this, what have they done? They've just combined bank as 1. They're lazy. Right, to save space. Right, to save space, they've just combined the 2 transactions on the 1st of March as 1 transaction. Do you see that?
Yes.
Right, there's nothing wrong with this. This is fine. Okay, what else do we have? Okay, this is a closing transfer. Did they say process closing transfers here? They just said record the above transaction in the general journal. They didn't specifically say process closing transfers. So that's why I didn't do it. But closing transfers, we did some earlier. Okay, I'll discuss this one. They called them investment expenses. I just called it transaction costs as it is, right?
Okay.
What balance would those transaction costs have?
Debit.
Yes. Okay, so you've got 500 as transaction costs. Remember we spoke about closing transfers in the notes? Where would you close transfer cost to? Profit and loss. It's not part of trading account because trading account is sales and cost of sales. Remember that?
Yes.
Okay, so what do? To close this account off, I have to credit 500 and then I would debit 500. Do you see that?
Yes.
Okay, that's why they've shown that here. Does that make
But why
sense?
why are they asking us to close that off though?
Yeah, they didn't specify close off the accounts, but they're showing it because it's at year end. So if it's at year end, assuming they're working out a profit or loss, then they would have to close that off. But that's a closing transfer.
Okay.
That only happens at the end of the year. Right, where would
So
you
would you
disclose
also
that? Statement of comprehensive income.
yes. So would you also have to close off your gain in investment?
The gain on fair value investment, yes, that'll be disclosed in the statement of comprehensive income. It'll fall under other operating expenses or other not
Okay, but
expenses, other
would you
operating income
close
and expenses. You've got income and then you've got expenses. It falls under the other. Okay, if it's a
but would you
loss, it's an
close that off
expense. If it's a gain, it's a profit.
so you close it off to your profit and loss account?
You could if you had to close off if you had to do closing transfers. Right, let me write it down here. Closing transfers. Okay, so now we know that they actually wanted closing transfers. Looking at the answer, this is an expense. How do you close an expense off? By crediting it. Do you see that?
Yeah.
Okay, so these would be the closing transfers. Okay, again, we have something else to close off. Right, how do I close off a credit? By debiting it.
Yes.
Okay, there's your closing transfers.
Okay.
Does that answer the question or does that help you?
Yes. Yes.
Okay.
It does.
All right, let's see
Thank
what
you.
else they've given you here. Just out of curiosity to see. Okay, so yeah, you can see they've closed that off. What have they done here? That was the fair value adjustment, same as the one that we did earlier. They've used fair value adjustment. They even say gain on fair value. It's fine as long as you've got the adjustment. Right, the vocabulary a little bit different. Gain or fair value adjustment. Fair value adjustments there, I've just indicated as a gain because it was a benefit. It wasn't a loss because you can have a loss or you can have a gain. Both are present. And I think if you go to the textbook I think also refers to it as a gain or a loss on the
Yes.
fair value adjustment. I think they're a little bit more specific, but
Are they
either or it's
picky
fine.
with from a marking point of view? Are they picky with your accounts, like the names of your accounts?
From a marking point of view, I can't comment. UNISA has never shown us their marking rubrics or their marking memos, so I don't think they'll penalize you. From a other institution point of view, right? Remember, these are accounts that are recorded in a particular business's accounting records, right?
Yes.
This is acceptable. This is acceptable, right? You can't call this a profit on sale of an asset. That's wrong. Because a profit on a sale of an asset looks at a disposal, not a fair value adjustment.
Okay.
Okay, so they shouldn't be that strict. If they're that strict, then they're being unfair. Okay, because different businesses use slightly different terms to describe
Yes.
these things. As long as it's close, you should have at least minimum fair value adjustment. This is better because you're indicating that this is a gain, not a loss on the actual adjustment. I mean, if I take away those two words, then I've got the exact same thing.
Okay.
Okay, but yeah, that they shouldn't penalize you for. That should be acceptable. Okay, all right. So that's fine. That's fine. And then they close that off as well. Okay.
Okay.
All right. Here's another example. What is this dealing with? Let me shrink this a bit. Okay. Will that fit? Yeah, that should fit. Okay. Look at the question. Things that stand out.
Okay, so then 2nd March
Yes.
2016.
It's good to look at the date. What else?
Okay, the following costs. So that whole lot of costs.
Okay, costs,
Is
but costs
important.
obviously relating to a machine, right?
Yeah, so no, all of them. So cost of the machine, delivery cost, installation cost, training cost.
Okay, when you say not all of it, what did you mean by that?
I would say I would highlight all of the costs, or would I look at the question first?
Well, we'll look at the question. Let's scope it out first so you're getting a feel for it. So you can clearly see that this is dealing with PPE. Do you agree?
Yes.
Okay, it's a machine that's being installed that's going to be used.
Okay.
Okay, what else did they say? During the year, there was repairs to a machine. Do you see that?
Yes.
Okay, they're not registered as a VAT vendor. So is VAT important?
No.
Well, not for the person that we've repaired or that they've repaired the work, the repairman. But we are a VAT vendor, or we could be a VAT vendor. Let's check. Are we? Okay, depreciation
Yes.
given you in the question. See it?
Yes.
Diminishing balance is important. Residual value. There's that note about residual. See? Okay. N Naidu is a registered VAT vendor. That's important. Is Naidu registered? Yes. So is VAT important? Yes. They're still using
Yes.
14%. That's bad. This has changed since 2018. They're still using 14. Have they told you to use 15 or are you going to be tested on 14?
No, I think they make a note it's 15.
They
So I
did
don't
make a
think they
note it's
actually
15, hey?
change. Yeah, it is 15.
Okay, so then I assume we need to change that or update it. But yeah, what version book is this? This is, yeah, this is 2019. It should have been updated by then. That changed in 2018. I don't know why they didn't update that. Maybe they just overlooked it, perhaps. Okay, it can happen, especially when they've updated so many textbooks, I guess. Ooh, I lost my spot now. Okay, there we're coming back to it. There's it. No, yes, here's it. All right, what else do you see here? Required, there. Disclose the machine and related costs in the financial statements. Right, this is a layout question. It's a disclosure question. Do you agree?
Yeah.
Right, so let's have a look at what we're looking at. So go back to the first bit. Cost of a machine, PPE. Historical costs. Delivery cost, would you include that in the costs?
Yes.
Yes, you would. Okay, remember you can't use it if it hasn't been installed. Okay, that's
Yes.
part of PPE as well. Installation?
Yes.
Correct. The training cost to operate the machine?
I don't think so.
Why not?
Are they talking about like training people to use the machine?
Well, um, that's what I'm reading, and I would agree with you. I would interpret it the same way.
So I wouldn't include that because that doesn't impact the value of the machine.
Correct. Okay, it's not acquisition. Do you agree?
Yes.
All right, so when we spoke about PPE, we said historical cost deals with the actual value of that asset the moment you bring it into the company. Okay, so in other words, those costs would be included in the cost price. This cost would be an operational expense. Do you agree?
Yes. Yes.
Okay, during the year, they also paid that to the repairman. What is that going to be seen as?
Expense and
Good.
operation.
Okay, normal operational expense. Agree?
Yeah. Yes.
Okay, good. If they were registered for VAT, just as an additional consideration, what VAT would you have on this if they were registered?
Input.
Very good.
VAT.
Yes, input VAT because you're buying or paying for those services. It's coming in. Good. Okay, it's not in this question, but I'm just giving you things to consider. It might be in a different question. All right, Naidu operates and depreciates buildings. Manufacturing equipment, 25% of costs. All right, so do you agree with me that you would have to add up this and then this is going to be depreciated at 25%? Do you agree?
Yes.
Okay, and it's diminishing
Yes.
balance method. Will that affect the first year? No, it won't. It'll be the same as cost, but it'll affect
Yes.
future years. If it's 25%, how many years will you have?
Sorry,
If it's 25%, how many years would you have?
on diminishing.
25 years. 25%, I mean. How many years? So if you have 20%, 20% can equate to 5 years. Do you agree? 25% can equate to 4 years.
On straight line.
Well, straight line is looking at the total period, the years. Right, so if you're looking at 25% per annum, diminishing balance, every year it's going to be 25, 25, 25. Right, you could stop at 4 years. You can continue because remember, diminishing balance never, ever, 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 ever ends.
Yes.
Do you agree?
Yes. So you can't. Yes. So if it
Okay,
was
how's
straight
your
line, I'd say 4 years.
depreciation? How do you go about calculating depreciation? This might help you. This is something that I would have shown you in 1502. Okay, this is how I do depreciation calculations. Costs, depreciation, accumulated depreciation, carrying value. Okay, let me show you what I mean in terms of straight line. So let's assume straight line. If it's straight line, what are you going to have here? Well, the cost. What is the cost? We need to add up all those amounts. 627000 plus 1425 plus 4332. Okay. All right, so the depreciation is 25%. Do you agree? If it was straight line, it'll be the same every year. Do you agree?
Yes.
Okay, then you'll add the depreciation year on year on year on year. And then the carrying value is the costs minus the accumulated depreciation. And you'll do that for each year. Right, so that's straight line. Happy with that?
Yes.
Okay, what happens if you have diminishing balance? Well, the same thing applies except, oh, hold on, we need to take out that residual value. Don't forget the residual value. Oh, didn't we read residual value here? Yes, we did. I'm reminding myself that I need to include that. Okay, residual value was 5,000. Do you see that?
Yes.
Okay, so if it was straight line, we also need to bring that into the working. So you would just add, okay, a minus 5,000 to the working for depreciation. So it's still cost. The cost doesn't change. You just minus the 5,000. Right, and you do that for each year. Notice, when you have residual, this will end up being the residual value amount. Because ultimately, with straight line, it should be 0. But it's not 0 because we've provided for that residual value.
Okay.
Right, so if it's diminishing balance, I'll leave it as is, okay? Did they show a table here, actually? Let's go have a look. Did they show you a table here? No, see, they didn't show a table. They just showed the disclosure. But they're only showing it for 1 year. Do you see that? I don't see any table. Yeah, there's no table. All right, so this is how I would have done the working for any depreciation calculation. I even normally do it with a picture, but this one we don't need because it's only for 1 year. Okay, but the only reason why I'm showing you this is because I'm looking at the number of years. If it's 25% straight line, then you would have 4 years. Do you agree? Because 25% is the same as 1 over 4. So it's a quarter each year. Is that all right? Is the maths okay?
Yes. Yes.
Okay.
Yes.
All right. So if you look at this bit, this is diminishing balance. Let's change the heading. Okay. So for diminishing balance, same thing applies. Minus the 5,000, close brackets, times 100. Delete, delete, delete. Okay. The first year should be the same because there's no accumulated depreciation. In the second year, what do you calculate this on? Carrying value. Do you agree?
Yes.
Okay, so carrying value, all right, is what you're going to be using to calculate the depreciation. Okay, times 25%. All right, and you do that again and again, and that's what you've got. All right,
So
so
do you
if
minus
you
the
look,
5,000?
pardon?
So when do you minus the 5,000?
Well, the 5,000 is the residual. The residual never gets depreciated.
Okay.
You don't depreciate the 5,000 residual.
So every time you do depreciation, you have to minus 5,000 for every
Because
year.
you've got a residual. The residual means you have some value at the end of the useful life.
Okay.
Okay, because you'll keep reducing it. It's more applicable here. It's not so applicable here because it's diminishing balance. Having a residual here kind of makes no sense because the amount is never going to end. It's never going to reach zero.
Okay.
Because if you look at this, if I just copy paste this, it's going to get smaller and smaller and smaller. It's not going to end. It can continue forever and ever and ever. Do you see that?
Yes.
The amounts are getting smaller. Does that make sense?
Yes.
All right. Notice the amounts get smaller, but they never ever reach zero. So you can do more years worth of depreciation. But if it's 25%, because of straight line would have indicated that you only would have had 4 years.
Yes.
Okay, so with diminishing balance, you would make that same assumption, but it's just the method. The method has changed. The calculation has changed. So I still would have had 4 years. I would have stopped there. Because if it was straight line, you would have stopped there. If it's diminishing, you would have stopped there. But with diminishing, you can continue further. But it just gets smaller and smaller and smaller and smaller and smaller. Does that make sense?
Yeah.
Okay, maybe just to give you some additional information, from a tax point of view, right, there are certain tax modules. Right, when you cover certain tax modules, they talk about capital allowances. And SARS has a rule for different assets. Okay, please don't worry about that for this module. This is beyond the scope. Right, but SARS will actually tell you. So if it's a cell phone, you can write it off over 3 years. If it's a laptop, you can write it off over 3 years. If it's a machine or if it's a vehicle, you can write it off 4 years or 5 years. Right? There are different periods to write off those assets. Right? So they're just giving us 25% as the proportion or the percentage that needs to be written off each year. Right? But obviously the 25% would have come from 4 years of useful life. Does that make sense?
Yeah.
Okay. All right. So that's just my little tip or note for you in terms of my layout and structure for depreciation. I always draw up those columns. 5 columns. The year, the costs, the depreciation accumulates and carrying, that's it. And then if I need a particular year, I just look at that particular year. Is that all right?
Okay. Yeah.
Okay. So that's how I would have done PPE workings. And I always do it this way because the cost doesn't change. The depreciation needs to be calculated. That you would just add up, obviously, accumulated. And then the carrying value, we could even put the formula here, actually. Let's write down value here, and then let's show the cost minus the accumulated depreciation. All right. So there's straight line, there's diminishing balance, some additional workings. Okay, happy with that bit?
Yeah.
All right, so let's go back to the question and see. We were discussing this bit here. Okay, we spoke about the depreciation. I drew up a table. We looked at the residual, and then they spoke about the VATs. Okay, was there any VAT mentioned here? Okay, question mark. We're going to have to look at their solution. Is this inclusive or is this exclusive? Do you know? We don't know from the question. Do you see that?
Yeah.
Right, they're telling us about costs, but whether those costs are inclusive or exclusive, we're not sure. Okay, we know that the repairman was a non-registered VAT vendor. That we know for sure. Right, but whether these amounts are exclusive or including VAT, that we'll have to look at the answers to tell. All right, okay, there's the answer. Now we know. See? It is inclusive. Do you see it?
Yeah.
Okay, there's a reason why they've got those workings there. It's because they've taken out the VAT. Right, this training cost they've included, I wouldn't have. Because this, they said it was training cost to operate the machine.
Yeah.
Operating, it's not installing. You're
So operator
operating
would
the
be
machine.
people.
This would be
Yeah.
training for people that are going to be, this would be for employees to use it, right? Do you agree?
Yes, I agree with
This one I would debate with them. It's not specific. Any costs that are directly involved. So if this wasn't training costs, let's assume this was offloading costs. We had to pay people to offload the machine, then I would include it. Do you agree? Because someone has to offload the machine in order for it to be installed.
Yes.
Okay, this is to operate the machine. That would, to me, that sounds like operations. I'm paying someone to go on training so they know how to use the machine, not how to install the machine or to offload the machine. Yes, I wouldn't agree with that. So you can leave it as is, but then you have to assume that this is directly as part of the cost. All right, let's go back to my working. Okay, we had costs here. No, we didn't. We haven't done. Okay, those are the closing transfer. That was the other question. Oh, the cost I've got there. Copy paste. All right, that was what I was looking for. Cost price of the machine, including VAT. Okay. We had 3 figures to add, right? Let's put another one, and let's put a note here. Assuming the training costs were directly related to the installation of the machine. Okay, then you would include it. So let's add that amount. What is the amount? It was 855. Okay, so we'll do 2 workings. There's the first one without those installation costs. As we said earlier, what we said earlier was correct. The cost is included, the delivery is included, the installation included. This is training costs related to operations that you wouldn't include specifically. You can, but then you'll look at that assumption. All right, so if this is including VAT, all right, how do you get it excluding VAT? We spoke about it earlier. VAT exclusive equals
over
times
100 divided by 115.
correct.
Or do you want to stick to the 114 for this example?
Yeah, but we're not going to use 14% because that's old. You're going to use 15% in your exams. So don't use 14% because that makes you get into a bad habit.
Okay.
Okay, they should have updated this textbook before they gave it to you. VAT changed in 2018 actually. They actually announced it in 2017 and it was effective in 2018. So that means 2018, 2019 and 2020 should have been fine. They should have fixed their course material. Maybe post this on the discussion forum. Tell them, well, their textbook needs to be updated still. VAT is 15%, 14% is being used in chapter 1. Okay, raise those points and then they can maybe fix it in the future. But yeah, don't use 15. You're going to be tested on 15%. Don't use 14. You're going to use 15. Okay, is that all right?
Yes.
Okay, there's the one amount with 15% VAT. I can do the same thing with this one, but obviously just bringing in those other additional training costs. Okay, there's there. And then obviously you can round this off if you want to. And that's it. All right, so that's the first bit. We looked at that part here. Okay, during the year, she also paid $2,750 to the repairman to fix the machine. The repairman is not registered, okay, as a VAT vendor. All right, so if you're looking at the repairs disclosed in the statement of comprehensive income, do you agree?
Yes.
Under expenses, do you agree?
Yes.
Okay. Is there VAT here? No. So you record the amount as is. You cannot claim input VAT if the other guy didn't have output VAT. Happy with that?
Yes.
Okay. All right. The depreciation, we did workings for that. The residual we spoke about. And then they just spoke
I just
about the
have a
VAT
question.
again.
I just have a
Question?
question on residual value.
Yes.
Would I minus it from the cost or would I minus it after I calculated depreciation?
The residual value must come off the value that will be depreciated. So before you multiply by the rates.
So I'd minus it from the cost.
Well, cost if it's straight line, yes. So here I took
Okay.
it off the cost, right? There's the minus 5.
Okay.
There's the minus 5. There's the minus 5. Okay.
Okay. And on
It's taken
straight
off the
line?
cost and then you multiply it by the rates.
Okay.
It doesn't make much
And
sense here doing it that way. Take it because remember the 5,000 is a residual, but because it's diminishing balance, it's going to continue to decrease, 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 and never get to zero. Right? Only because
okay.
it's mentioned, I would include it, and I would include it as there. Remember, the first year never changes; it's always the same. But it's the second
Yes.
year that changes because you have to use carrying value. So with
Okay.
carrying
So
value, you'll still have the minus 5 there.
okay. All
Minus
right.
5 there. Minus 5 there.
Okay.
Right. Yeah, you don't often see residual with diminishing balance because diminishing balance, the only reason why you have residual is to avoid not showing assets on your disclosure. Because where is this disclosed? Statement of financial position. Assets. PPE. So now, what's going to happen if you have no residual value and you're sitting at the end of year 4? Well, you're going to have 0 assets, right?
Yeah.
Is that correct? Not actually, because you actually have an asset that is still worth 5,000.
Okay.
Okay, so to avoid showing 0 assets on a company's financial statements, they tend to use residual value when you have scenarios like this, where you have a straight line method. Because straight line will give you 0 at the end of the 4 years if it's 25% per annum. Diminishing balance, you'll never ever ever get to 0. So I don't really need a residual because I'll always have the asset being disclosed in my statement of financial position.
Okay, I understand.
Yeah, because can you imagine seeing no assets for a company? You'd be worried.
You would.
Okay, so you have to consider these things, but obviously this isn't going to be the only asset we'll have. Hopefully there are other assets as well. But for this particular asset, you need to apply the residual because they mentioned in the question.
Okay.
Okay, let's have a look. All right, so are you happy with what they've done? Okay, we've done the same thing, but we've updated the solution. Okay, we haven't used 14, we used 15. Okay, we've done 2 workings. One working without the training cost because we assumed that the training cost was for operations. They've assumed the training cost was for the installation.
But they also didn't specify if the VAT was included.
Yeah, they didn't say that in
question.
their question, but remember, these are worked examples. Right, the test should be better. The test questions should be more clear, and we shouldn't have issues with this.
Okay.
Okay, because these are sample workings, they've given you the question and the answer. You can see what they've done. So I can see that they've made an assumption here that says that the training cost is part of the installation, not the operations.
Okay.
Right, but if it wasn't that way, you would have to do it what we've done it. Okay, how we've done it. We've done it 2 ways. Either or is correct. It all depends on what they want. Do they want us to put it in? If they do, we'll put it in. But then we have to assume it's directly related to the installation of the machine at acquisition. Okay, not afterwards. That's important, okay, because that's initial recognition. Initial recognition means the moment you buy the asset. The moment I buy the asset, I need to include all those other costs, transport, installation, okay? Those training costs, unless you specifically assume that it was part of installation at initial recognition, do you include it? Then you'd include it, times it by 100, divided by 115, get the VAT exclusive. Does that make sense?
Yes.
Okay, right. So you have 2 options, either or. Okay, just be careful how they word it. Just consider what they've got there. All right, the depreciation we already worked out. They use diminishing balance. Oh, the months. We didn't consider the months. I see we've got months here. When did they buy it? Did they tell us the months?
Yes.
Yes.
2nd March. But they
Yeah,
didn't tell us.
2nd March. Okay, you can see why I should have drawn a diagram, right? It's easy to make
But they didn't
mistakes if you
tell
don't
us.
draw a diagram. Where was the year end? Did they give us that?
Okay, there, yes, 31st December.
Where do you see that?
Under required.
Under required? Ah, there we go. Perfect. Okay, good. All right, so let's go and let's draw the diagram. Okay, what is it? March. Just read it for me.
Yes.
What is the start? What is the end?
Ooh,
You said December was what? Okay, here, let me do it. It's fine.
31st.
March. March was during the year. Okay, the end was
31st December.
31st December. Okay, and then the beginning would have been 1 Jan. All right, so March to December. Pro rata. Okay. If it's pro rata, you've got March, December. So March, April, May, June, July, August, September, October, November, December. Yeah, 10 months is fine. So you'll have the same as what we had here earlier. Okay, copy paste that. This amount was 632,750 minus 5,000 times 25 times 10 over 12. Okay, pro rata. Pro rata would have been based on, if it's depreciation, the cost should have been excluding VAT. Okay, remember we didn't know about the VAT until we looked at the solution. Okay, this was including VAT. This was including VAT. After we looked at the solution, we saw that they gave us inclusive amounts, then we had to take out the VAT. Okay, so I can actually create more tables for you if you want to know what this would have looked like without VAT. Then you would show your workings that we had here. This amount, this was the cost that we had there, excluding VAT. Okay, and then this was the cost we had with the other one. Well, actually, this is straight line, and this is diminishing balance. Yeah, that's fine. It will be the same cost. Okay, using what we had originally. All right, so that was what we saw after we looked at their solution, because then we knew that they actually gave us inclusive amounts in the question, and we had to work out the exclusive amount before calculating it. All right, so this working here was for the inclusive amount. We can do the same thing here at the bottom. Okay, looking at the exclusive amount. So this figure here, 550223.48. Okay, minus 5,000 times 25% times 10 over 12. Okay, so this was looking at excluding VAT. You have to use excluding VAT if you're a VAT vendor. Maybe as a note here. Okay, depreciation for a VAT vendor must be on the VAT exclusive amounts. Always. Always, 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 always. You never, ever, ever include the VAT. Because what happens when you buy the machines? You debit the machine, asset increase. Okay, you credit the bank, asset decrease, and you capture input VATs. Okay, remember that? Your basics?
Yeah.
All right, so when you record assets as a VAT vendors always use the VAT exclusive amounts. Right, this is what gets depreciated in property, plant, and equipment. Okay, if you don't have a VAT vendor, and if you assume that those amounts were exclusive, right? So obviously here in this scenario, okay, asterisk here. Okay, we had, I'm actually going to delete those amounts. Okay, and I'm going to put a note here. This was when we looked at the question. Okay, assume the amounts were excluding VAT, and then just solve. That's what we initially went with. All right, because we didn't know. We had a question mark. We weren't sure what those amounts were representing. There, inclusive, exclusive, we didn't know. All right, so just remember, when you do questions, you need to identify the VAT exclusive amount for property, plant, and equipment before you do the depreciation. That's all.
Okay.
Okay. Why do you do that? It's because of the reasoning we had here. Right, businesses get to claim the input VATs. This is claimed separately, not depreciated. Okay, is that all right?
Yes.
Okay, good. All right, so we've covered that. Let's have a look. Yeah, that depreciation. Then we've got the profit and loss. Okay, so notice when we spoke about this, we said depreciation is an expense. We said disclosure in the comprehensive income. I think you even told me that.
Yes.
Okay, the repair costs, you also said must go in the statement of comprehensive income. Right, that must be 2750 because it's with a non-VAT vendor. Okay, you can't claim input VAT if the person you paid didn't pay any output VAT, right? Because if the repairman is a non-registered VAT vendor, would he have paid 15% to SARS? No, he wouldn't.
No.
You can't claim VAT if someone else hasn't paid it over to SARS, right? Remember, SARS gets paid by who? The consumer. Okay, if this is the wholesaler and this is the retailer. Okay, output VAT for the wholesaler is input VAT for the retailer. Output VAT for the retailer, okay, is paid by the customer. Right, so who gets to claim? Businesses. Businesses claim input VAT because the wholesaler would have got it from someone else.
Yes.
Right, their supplier. So you have to have input and output before you can claim any VAT. Because they said it's not registered, you don't have any VAT here. Right, it can be a consideration if this is a registered business. If the repairman was registered, you would have input VAT. Then you would have to show this amount excluding VAT.
Okay.
Okay. All right, and then the disclosure here, there's the PPE. Okay, remember PPE is going to show the costs minus the accumulated depreciation. So in our example, okay, we're going to show the carrying value, and that's for year one. So we would have shown any one of these lines. You could have shown that line, you could have shown that line, you could have shown this line, or you could have shown that line. It doesn't matter which line you're looking at. Okay, remember we're looking at this, the carrying value. So just to put a note here, some more notes to remember for disclosure questions later on, for bigger questions. Okay. On the statement of financial position, carrying value is key for PPE. Okay, you don't show the cost, you don't show the accumulated depreciation. On the face of the statement of financial position, you only show the carrying value. Right, so if you are only looking at the statement of financial position, then I would do workings. Okay, show workings in bracket like they've done it here. Their working is good. Right, there's the working. Cost minus accumulated depreciation gives you carrying value. Okay, the carrying value is what you show on the face of the statement of financial position. Right, is that okay? Is the disclosure right? We're just
Yeah.
getting into it. Okay, we haven't got a long question yet with adjustments and all of that. That'll probably come up later on. Let's see. Okay, here they've given you, what have they given you? Oh, this is the notes. There's the notes. Right, here they're showing you movements during the year. This is the start of the year, that's the end of the year, and those were movements during the year. And that's it. Okay, I don't see any longer questions. The longer questions are probably here. Okay. All right, how are we feeling? Cheryl, are you okay with 1502 basics?
Yes.
Okay,
Yeah.
there's a lot of 1502 actually that you might have to go back and just revisit. But as I said, I'm going to revisit those concepts as we go and we look at individual questions. Right, so you'll see here, let's just jump ahead and see. Do we have nice long questions next week? Okay, there are still short questions here. Here's a short question. All right, they've talked about the disclosure. Okay, I see more disclosure. There we go. Here's an exam type question. This is a good question we can do. Because you're looking at the disclosure and they've given you an adjustment. There's probably, yes, adjustments. There we go. Right, this is a nice 1502 revision question. And we can look at that next week. All right, so I'm going to show you how to do this question as an exam. Okay, so this could have been an exam question where the exam question will actually look the same if you've looked at past papers. Probably not, but you'll probably look at it later on. You'll see they give you information, then they give you adjustments, and then they ask you to do something. Right, here they've asked you to do a lot because it's obviously the textbook. But in an exam, they'll generally ask you for 1 or 2. They won't ask you for more than that. All right, and these are the big questions here. Okay, this is disclosure. Those are popular. That you'll see. That you'll see. That you'll see. Right, and that's disclosure. And that we'll look at in terms of exam technique. Okay. Anything else here? Let's see. Do they give you more? How many do they give you? Yeah, there's 2.3. Can I ask you to do one of these for next week? Would you manage that?
Sure. Yes. Which
Can you
one
try
do
do
you
the
want me to
first one and see how good your basics are when it comes to workings? So when I'm looking at workings, I'm looking at debits and credits regarding these adjustments. So in other words, can I get the debit? Can I get the credit for each of these? Packing material on hand, you're obviously going to debit the stationery on hand, well, packing material on hand, and then you'd credit the packing material. Right, that's an easy one.
Yes.
Could you try and see if you can do some of these? And then if you're struggling with some of them, we can go through them in detail.
So do you want me to do the required, like the journal entries, the
No,
closing
don't.
journal entries?
The journal entries you can look at because they've done it for you, unless you're struggling with this. These
Okay,
are
so do
actually
you want me to
workings.
just...
The workings they've done here are very good. They're detailed. These are actually the answers. So maybe don't do it for this question. Do it for a question that hasn't given it to you. Has 2 given it to you? Let's check number 2. Has 2 given workings? 2 says, okay, yeah, 2 hasn't given workings. All right, so do this rather as homework because I will give you workings and then you can check your workings because we'll do the disclosure here for 2.
Okay, so let me do 2 then.
Yes,
Question
rather
2.
do workings for 2 because the workings haven't been done. If you're doing it for
Okay.
1, you're wasting your time because they've already done it. You can just look at the answers. Right, those are the debits and credits. See that?
Yes.
Okay, journal entries are workings because you're debiting and crediting different accounts, but they still don't have the workings. So, for example, they don't have the A or the I or the L and that.
Okay.
Yeah, but I think in terms of prep, rather do 2 because then I can ask you for your working and then we can draw up the working. Don't do the disclosure, just do the workings. All right, so for each of these, for transaction number 1, debit, credit. For transaction number 2, debit, credit. For transaction number 3, debit, credit. Because that'll help you more than doing the disclosure. You'll see how easy the disclosure is if you know how to get the debits and credits.
Okay, so I'll just do the workings for question 2.
100%. Okay, because I don't see workings in solution 2.2. I only see the answer. Okay, they've given you the final answers, but no workings for the answer. Right, and then the workings, you'll see the workings help you to get the answer. I'll show you how to do it next week.
Okay.
Okay, all right, so let me put a little note here. So when I email it to you, you have it. Exercise 2.2. Okay, please do workings for the adjustment. That's all.
Okay.
All right, so debit question mark, credit question mark, and do that for all of them. And then I'll show you how to take what you've done there, because if I know you can do this, then we can just look at the disclosure. But even when I look at disclosure, it's always a good idea to bring it back to basics. That's why this is so important. All right, so keep it simple. Focus on the transaction analysis. Okay, so when I looked at this, when we covered some basics from last week, I spoke about steps. Do you still remember the steps?
Yes.
What are they?
So it's the account.
Very good. Then?
Ooh, two I forgot. I think it was.
Accounts?
Is it increasing or decreasing?
Okay, that's
Is
this
that one of
step.
them? I know the last step is debit or credit.
Yeah, so what step did you miss?
I don't know.
Okay, so let me give you an account. What's the next step?
It's an asset.
There we go.
Elements. Okay.
Okay, that's the right step. So if you've got stationery, all right, so here's an example. Okay, if I went through my steps, accounts, stationery, elements,
Expense.
increase because it's record keeping. Be careful. You're recording an expense. That's important.
Yes.
Okay, debits. All right, that's all 4 steps. See? All right, that's how I get the debit. And then
It would be
creditors.
Liability.
Yes.
Increase debit. Credit, sorry.
Yes,
Credit.
that's right. Okay, so see, those are the workings. But now, you don't have to write it in that format. Most people write it like this. Okay, and then show the workings in brackets.
Okay.
Okay, so I just want this. That's all. Just the working. You can do it like that if you prefer, if you want to go through step by step. But that I would have done like right at the beginning of 1502, just to get students started. But you've got 1502, you've completed it, so you have the skills. I would expect to see something like that. I think that you're probably okay with.
Yes.
Okay, awesome, good. All right, so see if you can do that for exercise 2. Then what we can do together next week when we start, I can take your workings that you've done and I can show you how to actually address the disclosure. It's always a working. If you get the right working, you'll know what to do with the working. Okay. Awesome. All right, thank you very much. It was a good session. I can see your basics are good. You've got the understanding. Obviously, it's still early in the semester, so practice will come later on. Don't worry too much about that. We will get through more example activities. If you do want to do revision, I would say just go through the content that's in the actual study guide as well as the textbook to help supplement what we've covered so far. All right, so we've covered study unit 1. You can go have a look at study unit 1 content. Next week, we can look at study unit 2. Study unit 2, we would have completed exercise 2. Okay, we'll probably look at 3. Exercise 1, I'm not too worried about because looking at their solution, the solution is very, very, very detailed. Right, so even if I just do 2 and 3 with you, then you could even go back and look at 1 to see if you'd be able to complete what they've done. Right, you'll see if you can do 2 and you can do 3, those are probably the more difficult questions because 1, they've given you all the steps and all the workings.
Okay.
Okay, all right, so let's focus on that for next week. Disclosure. Let's make sure you're comfortable with the layout and the format. And then once we've covered that, at least then I know that your 1502 is perfect. Right. Study unit 1 and 2 all cover 1502 content and theory. There's nothing new yet. Okay, we haven't looked at anything regarding partnerships or changes in ownership or anything like that. So all of this is still basics that you should know.
Okay.
Perfect. All right, Cheryl, take
Will
care.
you
Stay
email
safe.
this to me?
Yes, I will. I will email this to you after today's lesson. I'll save it and I'll email it. And then obviously the video, I'll send that once I've uploaded it and then it's available.
Okay.
Okay, perfect. All right, take care. See you next week.
Okay, thank you.
Okay, bye, Cheryl.